Hey, good morning. All six of you rocking it out in this room with me. How we doing, gang? Hopefully some more people show up. If not, it's just the cool kids. I can say that while they're not here. Good morning, Ron. Good morning, Bob. Good morning, Steve. Pete, Erla, Peter, and Victor. It's great to have you guys. So stuff started blowing up last night, huh? Messed up the oil market. I was sleeping. I missed it. Happens sometimes, right? Sometimes there are news events that create chaos in the markets that make it jump and bump and spike and all that good stuff. While we couldn't predict the bombing of Iran, we can look at forexfactory.com and know that there is news coming at 10 a.m., the preliminary University of Michigan consumer sentiment and their inflation expectations. And at 10 a.m., when they send those news reports out and express them to the world, the market may get a little crazy. So every morning I check news and I make sure I don't get caught in the crazy. Everything I talk about comes from the education page, guys. Try not to hold back. Try not to keep secrets from you. We've got 7 of you in here. So this is going to be more for you guys that are new in the first hour. We're going to talk about one trade. We're going to talk about that high probability trend trade. If you've spent any time in my room, you're like, wow, he says the same darn thing every morning. Every morning, this Yahoo talks about momentum. He talks about path. He talks about entry. And usually by the third day, you start to believe it a little bit. By the third day, the language begins to sound familiar. By the third day, you begin to recognize these advantages. And you're probably not great at them yet. Because how could you be great at something 3 days in, right? But what you're learning, and you may not even know you're learning, is you're learning how to read these indicators, guys. You're learning how to take a look at your charts and really say to yourself, I've got some advantages in play. I'm going to look for an entry. And I think even more importantly, and I took some pictures and posted them this morning of it, I don't have the advantages that I need. And because they're not present, I choose not to trade. And guys, choosing not to trade will be one of the most difficult things you ever do because it means that you're not active. And your brain is going to tell you. You guys remember the old Tom and Jerry cartoons where there's the devil and the angel trying to talk Tom into bad things? Guys, you're going to have that little guy on your shoulder saying, "Man, I know your rules aren't met, but maybe if you just took this trade. Hey, I know that your rules aren't met, but what if it goes anyway? You should probably be in this move." And man, it's hard to fight that some days. So we have to build trust, guys. Trust helps you avoid that little nagging voice that has you typing "but" on your charts. Yesterday we were joking that somebody showed me their butt. And it's one of the most common things. My rules are almost met. This isn't true, but. And guys, your butts are going to get you in trouble. So we're going to focus on one trade for a little bit. And we're going to call it a high probability trade, guys. Because a high probability trade means that every indicator on every chart, I make it sound like there's a million of them, but everything agrees for the trades. Everything agrees. Everything says, hey, Victor, life is amazing and you have an edge, take a trade. And this high probability trend trade, guys, is going to teach you to recognize when that is happening, and even more importantly, when it's not happening. And Pete's absolutely right. It's a tough discipline to master to learn how to do nothing. Traders want to trade. You guys are all alpha males and females. You've been at the top of your class. You've been just pillars in the business community. And you have that old school mentality that if I'm not busy, I'm not making money. If I'm not working, I'm not making money. If I'm not active, I'm not making money. And guys, trading is very much the opposite. You will find that 90% of your day is not making money, but 90% of your day is also not giving money away with avoidable losses when you don't have an edge. 10% of your day is when it all comes together. 10% of your day is when you have the advantages, when you have an edge, when you recognize a pattern. And guys, you can't wait to get in the market because you will know with a little bit of study that pattern wins more than it loses. It creates a statistical advantage. That is the high probability trend trade. So if you focus on a little bit of chart reading initially, you're going to understand where the market is likely to continue. This will be your entry for the high probability trend trade first. You're going to be able to see a trend, establish a couple advantages, and then enter that market where it's most likely to continue with the trend. You will understand where the market is likely to go. This becomes an outstanding spot to take profits because you're going to see momentum pushing a market. You're going to see key Fibonacci areas, and you're going to say, wow, with this level of momentum, that's where it's likely to go. That's where I'm going to get paid. And you'll also understand where the market is likely to stop. And man, it has been a 100% display of understanding where the market is likely to stop today. And you guys have rules to keep you from hoping the market goes up. Your opinion says it goes up. Your indicators say, hey, guess what? Not yet. We're not there yet. And we're not going down either. You're going to see all this stuff. Great picture, Pete. And it's all a byproduct of you learning to read your indicators. So what we're going to do this morning is we're going to break down this high probability trend trade. It's only 3 rules. When the rules are true, you have the advantage associated with it. And guys, the first 30 days with me is really a study and a focus on recognizing advantages. I want you to be able to look at your charts, and I want you to be able to say out loud, like, I mean, scare the dog, frighten the cat, right? I have strong triggers on my large chart, rule number 1. Therefore, I have the advantage of momentum. I have no termination conditions on my large chart. Therefore, I have a clear path. Let me go define an entry where the market is most likely to continue, guys. It only takes 3 rules to enter the high probability trend trade. And it's the first 2 rules, having the advantage of momentum and having the advantage of a clear path. This is going to be your foundation, guys. This is the bedrock on which you will build your trading castle, because when you understand momentum and path, once you get these 2 concepts down, study them, trust them, you have everything you need to create your own trading plan that is consistent, that is profitable, and that is chock full of the 2 most important advantages that I teach. The third advantage is specific to the high probability trend trade. This is an important one, though, because this one teaches you a lot about stop placement. It teaches you a lot about fluctuations in the market, when you should pay attention to them, when you should just ignore them, and ride the momentum and clear path. So these 3 rules, they happen on only 2 charts. Less is more. Some of you have a history trading and you're like, well, I need 37 time frames and I spent $38,000 on 152 indicators, and without this much information, there's no way I can be successful. Less is more. I firmly believe that. You hear high probability trend trade. Can you explain that in more detail? You know what, Syed? How about I spend an entire hour this morning talking about nothing but the high probability trend trade? We're going to break it down into the individual rules. I'm going to show you exactly where to find those rules, and we're going to see what they look like, what they mean to you, and how to piece them together to create a trade. That's actually my first hour every day, so I'm excited that you're here for it. So we have 3 rules, and they're met on only 2 charts. These are the workspaces that you have when you open up NinjaTrader, guys. There's a large chart. Typically opens up on the left-hand side because most of us read from left to right. The large chart leads the way. It's a very slow-moving chart, guys. It's hard to see change on a large chart. It's a broad stroke of a brush, but it shows the overall opinion of the market. Because it is a big, slow chart, you really get the vibe of what's going on and what the people in charge want to have happen. So we use the most current bar, literally 1 bar, on the large chart, and you'll be able to define direction, momentum, and areas. Your first 2 rules, giving you the advantage of both momentum and absolutely nothing in the way, those happen in that first bar on the large chart, guys. And those advantages, rules 1 and 2, because it's such a slow-moving chart, they remain constant. And when they're met, we go to the small chart. And inside of this 1 bar, you're going to see a retracement. And a retracement is defined as a little pushback, a little move counter to the underlying trend. The large chart defines the underlying trend. So we're going to take advantage of this little move. We're going to pinpoint where it's most likely to bounce, and that's what's going to get us into the trade. And then typically you see the continuation up to 70 to 80% of the time. All of this happens inside of that one bar. So we're letting the large chart tell us, hey, it's time to look for an entry. And then we're going to refine that large chart. We're going to pinpoint our entries. This is going to allow you to reduce risk. This is going to allow you to maximize your profit potential. We use these two charts because Novak men are horrible at analogies, but we love metaphors, guys. Who are you trading with against? The large chart. It's the big crowd. It's the men and women with the money, the influence, the charisma. They create trends. They produce the momentum that we want to take advantage of. And they also react at those key Fibonacci areas. So the large crowd is like the world's greatest lazy river, guys. I'm on a float. I'm going with the flow. I've got a pina colada, getting a little bit of sunshine. The large crowd typically wins. This is who we trade with. The small crowd is the small chart. These are your fighters. These are the wonderful people with enough money to create these little retracements against everything that the large crowd wants. Rule number 3 for the high probability trend trade is designed to pinpoint where their failure is most imminent. And these guys fail typically 70 to 80% of the time in their fight against the large crowd. Rule number 3 puts you in where they are most likely to fail. That also happens to be where the market is most likely to bounce and continue with everything that the large crowd wants. So it's only 3 rules. It's only 2 charts. And we're going to spend the entire first hour learning the trigger line and the Fibonacci rules for when it's okay to trade. And I say when it's okay to trade when my rules are met. So these rules describe a pattern. This pattern is repeatable. This pattern is testable. This pattern is something that you can verify. I'm going to teach you how to study it, and you're going to prove to yourself that it wins more than it loses. It's okay to trade when the advantages are in place. As a brand new user, you're going to be pulling the reins a little bit. You're going to be sitting on your hands a little bit, and I want you to believe that it's just not okay to trade if the rules are not met. Understanding that this is a foundation trade, and once you understand the very basic concepts, you begin to see more in the market. Good morning, Cav. It's great to see you. Everyone in the room has the ability through NinjaTrader to simulate, to practice, to take practice trades, to work on management, to learn the mechanics of entering, of exiting, moving stops, all that good stuff, guys. The first step in becoming a confident trader ASAP is post in the room. Post your pictures, post your questions, post what you see, and post your trades. And if you do this, every time you post in the room, you get a private session with me. So if you post a trade in the room, the one thing that I ask, let me go back to my pictures, I've got a million of them, is that you go back and talk about, this is how I read my indicators, and this is what I thought about momentum. This is what I thought about termination conditions, and this is where I chose to enter. If you give me this information and tell me what you saw, I get to do my job more effectively, because my job is to teach you to read these indicators effectively and accurately. So I need to know what you saw. If you take a trade and you have no idea what was going on, but the background is green, so you decided to go up with it, I want you to put, hey, Mark, the background was green. I decided to go long. Look what happened. And we'll talk about these 3 advantages, things that you did really well, and I love to celebrate victories, and things that maybe we can improve upon, whether it's a chart read, whether it's an entry, whether it's an exit. Guys, I'm going to give you everything I have in my arsenal to help you get to your goals a little faster. But you got to give me some information. The people that choose to skip this step tend to take longer to get to where they want to be. The people that post the most are the people that typically win the most. So take advantage of that, guys. It really is. It's a private session. You'll see it in the second half of class. I'm going to give you a plan, a very simple plan. I don't have any information about entering based on the volume of transactions, Syed, and I apologize. What I do have is an amazing way to determine where to enter based on a pattern that you can prove wins more than it loses. How was that? What if you could enter the market without ever knowing the volume? and still have an edge and still have an advantage. That's what we're talking about this morning. When I say less is more, I firmly believe less is more sometimes. So do me a favor, sit through this first hour. Let's look at this one trade, and you'll realize that you can get crazy accurate without ever knowing what the volume of the market is. Um, it's kind of neat. I'm going to give you guys a plan. The plan is a roadmap for you as a brand new user. It gives you the highest probability trend trade, a way to take it, a way to manage it. And then the second trade on the plan is based on the things that you see through that high probability trend trade. And it opens doors and it creates more opportunity for you. Your job is going to be to learn these looks, guys. First, to learn, and I can't stress this enough, don't put the pressure on yourself to find a trade as a brand new user. Learn how to identify momentum. And then when you're comfortable with that, learn how to identify a clear path. And when you're comfortable with that, we'll go through the process of defining an entry. We're going to do it all this morning, but you probably won't be an expert by the end of the day. Maybe one of you will be gifted and talented, but when you learn these looks, it slows the market down. When you learn these looks and you study these looks, you develop trust in these looks, and you find yourself in a position where you refuse to not enter the market because you know you have an advantage. That's the second piece of the puzzle. Posting in the room is always one of the greatest things you can do for yourself. Using the spreadsheet that I'm going to drop in the room right now as we speak. This spreadsheet has 4 tabs, guys, and it is 100% dedicated to creating recognition through repetition for you. The first tab is what we call the basic rules. So Syed, as we're learning, and you're learning these advantages so that you can have that edge getting into the market, in the green, you're going to see what it looks like to have rule number 1 met. And I have already put 60 pictures in there of what it looks like to have the advantage of momentum. These pictures are not only just pictures of strong triggers, but they are annotated, and it says exactly why they're strong triggers, what it means to you as a trader, what it means to have nothing in the way, and exactly what it looks like, and a recipe for you to create a connection between the visual in your brain, and also some on the entries as well. And then we were having the discussion, if you guys scroll back up through the day, you're going to see that understanding when the advantage is present is equally as important as understanding when your advantage is gone. So if I rely on momentum, I have to know what it looks like when it's gone. And if I rely on a clear path, it's imperative that I understand what it looks like when my rules aren't met. So the red section is your pump the brakes section. It's your pause section. It's your, hey, I don't have that advantage that I'm looking for as a new user. I'm going to wait for it to come up. So the first tab is a great study tool, and I'm going to give you some great stuff to fill it out yourself. The second tab is over 500 pictures of Nexgen users using this pattern, using the idea of momentum and path and finding an amazing entry at areas inside of triggers. And they were so awesome that I just stole them. I stole them from Bob B. the Man, and I said, Bob, you are getting way too good at this. You're recognizing this pattern. You're doing amazing with it. And I'm going to put it into the spreadsheet so other people can recognize that when they have momentum and they have a clear path, they can define the perfect entry and they can find a way to capitalize effortlessly with the software. And Bob said, Mark, take it. I want to take care of the new people. Thank you for that, Bob. So guys, all of these aren't me saying this works. These are you guys showing me that it works. And I think that this is a great study tool for new users. And then Syed, for you, here's how we define entries, both long and short. When the rules are met, it's broken down piece by piece. We're going to do it together. Some of you want to trade the NASDAQ. The NASDAQ is about 10 times faster than the S&P or crude oil, but it's a wonderful market if you know your rules. There's some ideas that I've had. Management will be on the plan that I give you. This is the most basic management approach I could ever write, and then there's ideas for when you can hold for bigger moves. And the great thing is that you're going to start seeing more. When you keep it simple, you'll see more. When you recognize momentum and path, you'll see more. This blue section is for the more that you see, and this is the more that I see. And I shared a lot of it with you. What I want you to do is I want you to go through and start snapping pictures and filling up your section to build your plan. When you see your rules met, take a picture. When you start to see patterns, take a picture. When you're working on management, take a picture, but do me a favor. Drop those pictures in the room and say, hey, Mark, this is what I saw. This is what I did. Do me a favor. Give me your experience. Tell me what you see. Did I read my indicators right? Was there a way to do it better? And guys, I promise you, I'll give you all of that. And then finally is the trade tracking sheet. This is the one where I see my brother jumped in the room. John doesn't realize how much he helped me in the beginning with this one. So the trade tracking sheet, guys, every time you take a trade, I want you to drop it in here. And I want you to identify momentum and path, because one of the things that I firmly believe is that you will begin to see a correlation between the winners and having those two advantages, between the ease of trade and having those two advantages. So learn to identify those two first. And then when you post in the room, there's always feedback. Sometimes the feedback is, oh my gosh, this is perfect. How did you do this? Just kidding. I know how you did it. This is amazing. What a great chart read. What a great entry. What perfect management. And guys, you'll get that feedback. This is perfect. Go put it in your trading plan. Make sure you can repeat that. And how do you repeat it? You repeat it because you wrote the recipe for repeating it. You identified your advantages and you made a very clear recipe on how you can find that success repeatedly. And then the second thing is, a lot of times you're going to notice a pattern in yourself. I took 3 trades and I lost all 3 trades. And in your brain, you're like, they were perfect. The market sucks. I can't believe they did this to me. But when you post it in the room, when I posted it in the room, John Novak said, hey, Mark, you're trading in determination conditions. You're trading into lines that could stop the market. You see them. Here's the recipe to fix it. Here's how you move forward and away from this challenge. And guys, this was my challenge. And it was the feedback from John Novak when he taught this room. He didn't just say, dude, stop being a dummy, which he could have because I'm a sibling. He said, hey, Mark, that's a termination condition. Here's the recipe to identify it. And before you take a trade, I want you to say that recipe out loud. And eventually you'll stop trading into them. And he was absolutely right. I needed that feedback, because that feedback every morning, I started going back and looking at what I did yesterday. So if you look at your trades yesterday, what worked? That's what we're going to focus on today to become a better trader. But you also have to ask yourself what didn't work, because that's what you're going to focus on avoiding. And I knew my problem was termination conditions, so I got like this heightened sense of awareness on the lines on my large chart, and then eventually I find balance. But if you do that, it will accelerate the learning, guys. It'll get you where you want to be faster. So post in the room, post lots. You can't post too much. The record in this room is 77 charts posted in one day by one person. That person happens to be killing it these days. And then use that spreadsheet, guys. Take a lot of pictures. The more pictures you take, the more you're going to see. The more you annotate those pictures, the more you're going to see. And I like to show my picture count every now and then. We're at 4153. Guys, if you started the day with me, or started the week with me on Monday, we were right around 4,000. I did over 7,800 last year. And all it is pictures of patterns. And that's why I read charts fast. That's why you will read charts fast. So I did this picture. I added this one in because a new user hates to be idle. A new user hates to not be in a trade. Guys, we talk about this high probability trend trade in the first hour because this is the one that opens your eyes to see the rest of the opportunities the software provides. And they are so many out there. And then once you get this one down, once you understand momentum path, to find that pretty simple entry, it takes you to the next trade on the plan. And this one opens doors and keeps you a little busier than you were with the high probability trend trade. And once you have these two down, guys, you just start to soar. You start to move forward. There's more opportunities, and you will create your own plan. And it's going to be based on your ability to read the indicators. So realize that it's not a prison sentence to keep you on one trade, guys. Sky's the limit once you can read your indicators. So we're going to focus on 3 advantages, and I'm going to remind you that the first 2 are the ones that are going to carry you to the promised land. The golden goose, the keys to the castle, every cliche we could ever come up with. Large chart needs strong trigger lines. The large chart, the big chart, the slow chart, the large crowd, everything starts there. And it must have strong trigger lines because I'm going to insist on the advantage of momentum. if I'm going to take a trade as a brand new user. Here's your little safety check. The background on the large chart will define the direction of the market. If it's green, I want you to say, hey, the market's going up. It's my job to go up with it. If it's red, the market's going down. I've got to go down with the market. Guys, the only way you can ever have strong triggers is if the trigger lines, these are your small triggers, 2 solid lines, and your large trigger lines, the dashed lines. Guys, small and large triggers must be green as well, or you don't have rule number 1 met. Small and large must be red as well, or you don't have rule number 1 met. And guys, this helps new users a lot for when you think you have momentum. If that color check doesn't come true, you're like, okay, I'm gonna sit still for a second. Let's talk about what it means to have strong triggers. In an uptrend, this is my visual, and I think this is the easiest way to learn it. In an uptrend, my small triggers must break away from and be above the large triggers. It's the space created between the 2 triggers. This is what lets me know that it's a strong trigger look. And one of the easiest ways to create that recognition is to say to yourself, strong triggers look like scissors that are open, because when scissors are open, they can cut, they can get work done, they can cut you a check, as Jerry says. In a downtrend, it's that separation between the small and large. It's those scissors open. That's my strong look. So when the scissors are open, it's strong. And when I have strong triggers, the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum is one of those things that you're going to hear in the classroom all day long. You're going to see OFM annotated on charts, odds favorable momentum. And guys, that separation, that strength pushes a market in the direction of the trend. It's that same strength that we're looking for to give us the potential to break key areas. And when I have strong triggers, God bless it, it will help cover some of the mistakes that we tend to make as new users. Hey, good morning, John Novak. Friday the 13th, the luckiest day to trade of the year. I love it. So guys, strong triggers is that clear advantage. Rule number 1, everything is great. Let's go to rule number 2. But strong triggers go away every now and then. And when your scissors close, when the small triggers work, you don't see the scissors the way you indicated. All right, hold on just 1 second. Do you see the small trigger, Syed? Let's go through it. I need that. I love this feedback. This is your small trigger, and this is your large trigger. Are we good there? Basic indicator language. Cool. So in an uptrend, small triggers must be above the large triggers. So if I just draw a line on the bottom of that small trigger, I can see that they're above the large triggers. Large triggers are widening, the smalls are above, so I'm going to draw a line on the top line of my large triggers. See how it creates a V? I'm going to turn the top line into the top blade. You see the legs of the scissors. That's it. You see the blades of the scissors? Do you see how they're separated? Okay. So that is a remedial drawing. Why do you need eyes? So it's the blades that we're focused on. I see what you're saying. We're focusing on the blades because, Syed, if you look at a pair of scissors, and I say, are these scissors open or closed? Are you going to look at the handle, or are you going to look at the blades? You're going to look at the blades because the blades tell the story, don't they? The handles are just there so that you can use the tool. Okay, so when we talk about open scissors, this is great. I love this. When we talk about open scissors, we're talking about the blades separated, separation between the small and large. Does that make sense? We don't even need a handle. It's just blades. There we go. So when the blades are open, Syed, you have the advantage of momentum. When the blades are closed, that advantage goes away. And that's just a visual. You're a math guy. I'm an artsy fartsy guy. What may work better for you is when the small triggers are above and away from the large triggers, this is your advantage of momentum. When the small triggers are below and away, the space between the two lets me know that I have strength. When the small triggers return to the large triggers, that's when we have weakness. So we go from the odds are favorable for the market to continue down, and we end up at anything can happen up or down. Does that make sense? And I can't tell you guys how much I appreciate when you guys make me explain it a different way. The classroom gets better. It really does. Not just scissor, open. Separation is strength. There's your key phrase. John, go away for a little bit. Separation is strength. That's probably the one that's going to help you. Separation is strength. When there is no separation, there is no strength. Rule number one is met. Rule number one is not met. Perfect. So if we go, so let's go to the live market right now. Let's see what's happening in the live market. That's my small chart. We're going to define momentum on the large chart. So there's two things that I talk about, Syed. The first one is that the colors must match. So because the large triggers are red and the small triggers are green, I don't have the advantage of momentum yet. They all have to match. They have to be the same direction. If we back it up just a little bit, do you see how the smalls are below the large? The separation is present. These are strong triggers, and that strength helped break through these areas. And if we back up a little bit, separation, separation. So this is our first look. Separation is strength, and when the smalls return to the large, the momentum is gone. Inside, look what happened. There's a big retracement right from the middle of nowhere because the strength is gone. So we're focused on one look. It has nothing to do with Fibonacci. It doesn't even have anything to do with price bars. It is nothing more than a separation of the small and large when all the colors match. That's your advantage of momentum. Momentum is the first rule, absolutely. So let's think in terms of a flow chart. When I have momentum, when rule number one is true, when that advantage is present, I'm going to make sure that there's nothing in the way that could stop a market. I'm going to make sure that there are no termination conditions. So what is a termination condition? A termination condition is a Fibonacci-based indicator. We're going to go straight to the rules for this one. I'm going to show you the technical definition. A termination condition is a Fibonacci-based indicator that may reverse the market. May, might, could, has the potential to reverse the market. And it's going to be a comparison of that area with those trigger lines, the same trigger lines that define momentum. Areas that may stop, that may reverse, that may create an untradeable bounce. We're going to look at blue Fibonacci support, red Fibonacci resistance, yellow one-to-ones, and divergence high and low lines. And the easiest way to say this, can I close the attendance at the bottom so I can see the charts larger? You can pop out on your side, Syed. I'm on a 32-inch screen, and I don't have anything in the way on mine. Mine is as big as it could possibly get. But if you come to yours, you can use the pop-out screen, and I believe that will make it bigger for you right there. Whoops. And I just minimized mine, so I need to maximize mine again. Dagnabbit, what did I do? There it is. Oh, and we are all over it. So that pop-out should help you out. It should make it bigger. When we talk about termination conditions on the large chart, when we talk about areas that may stop the market, that could produce a bounce, these are the areas where the large crowd are making decisions. That's how I like to think of it. So we're just going to name them right now. Remember, large chart. We're going to look for divergence highs. That's a magenta line. This prints off of a pivot if there was a loss of momentum in the move. The software does calculations behind the scenes. You don't have to do any math at all. But if you see the market go up and down and this magenta line prints with a negative number, there was a loss of momentum. Momentum didn't follow price. We use this magenta line so that you guys can recognize an area that may stop the market. There's the cyan low. It's the same thing. It's a divergence low. Divergence means loss of momentum. You'll see it at a low print off of a pivot if there's a loss of momentum. You're going to see Fibonacci resistance and support. Resistance is the red line that goes across the chart. Support is the blue line. You're going to see yellow one-to-ones. These are fibs that print in the moment. And you're also going to see a midband. And a midband is just a moving average. And if price is below it, you'll notice that it turns magenta. Magenta can be used as resistance if the rules are true. And if it turns green, it means price is above it. It can be used as support when the rules are true. So all of these areas are areas where I like to say decisions are made. The large crowd, the people that control the market, are more likely to make decisions at these areas. So we use these areas to help us define where turns can happen, where bounces can occur. And these are the areas that can be termination conditions. I'm going to put that picture in the room for you. It's also, I'm going to give you this PowerPoint so you have it. So what we do to define a termination condition, to define an area that could stop the market, that could create a bounce, that could create a reversal, is we're going to allow the large crowd to get there. We're going to allow the large crowd to get to Fibonacci resistance. We're going to allow the large crowd to get to Fibonacci support. So price, dynamic Renko bars, have to reach Fibonacci resistance. When price reaches an area, that's the first step. I just dropped it in the room for you. Look right above you, Syed. Anything that I drop in the room, whoops, why did that do that one? Hold on. Anything that I put in the chat box, you can click, well, that's hard to see, so let me do this. Anything that I put in the chat box, I'm trying to sneak it over. You can't download it. It won't allow you to download it. Can you right click on it and save the image? Because the file that I just posted, the picture that I posted is there. You're also going to get these pictures. I'm going to give you a zip file, the same one that I gave you last time. Save image is not a... Say, do me a favor. I'm going to do this. This is going to be so much easier, I think. This is my email. Will you do me a favor and send me a message and say, hey, Mark, give me those files, and I'll give you everything I have, and I'll drop it into your email when I take my first break. I'll get you all the pictures that are in the PowerPoint, and I'll get you all the documents that I give after the first hour to help you study, to show you how to study, to give you checklists, all that good stuff. I don't know why. Some people have challenges in the room with that. It's usually computer, but let's just circumvent it, right? Let's go and get you fixed. So how do I define a termination condition, guys? When I have momentum, I'm going to look for termination conditions. Well, price reaches resistance. Once price reaches the area, the price bars reach the area, I'm done with price. The trigger lines will tell the story. So I ask myself, where are my triggers? My triggers remain below resistance, guys. This is what defines resistance as a termination condition. So the market is moving up, it's going up, life is good, price reaches resistance. Where are my triggers? They remain below. Absolutely no trades into that area. That area could stop the market. That area may create a big untradeable bounce through the fight between buyers and sellers. That area could reverse the market completely. And one of the things that I have to accept as a trader is I'll never know what the reaction is going to be. Rule number 2 is based off of thousands of pictures where the market created a loser if you chose to trade into the area with the triggers below. That's why rule number 2 is in place. Price comes down, reaches Fibonacci support. When it reaches Fibonacci support, when it reaches yellow 1-to-1's divergence low, I have to ask, where are my triggers? My trigger lines remain above support. Support is a termination condition. Absolutely no trades into the area. Rule number 2 is the most broken rule. I would encourage you to study it. Every line that you hit is going to be a termination condition at least for a moment. In the live market, it looks just like this. Price comes up, reaches Fibonacci resistance. The trigger lines remain below. This is a termination condition. Absolutely no trades into the area. I don't know what the reaction is going to be. Congratulations, Pete. I love it. Syed, I feel like we're half listening this morning. A termination condition. This is straight from the rules from the website. Is a Fibonacci-based indicator that may reverse the market based on a comparison of the area and the trigger lines. These are the areas that can be termination conditions. What does a termination condition do? When one is present, when I define an area as a termination condition, it means don't trade into it. The market could bounce. Don't trade into it. It could stop forward momentum. Don't trade into it. This is an area that could ruin your good time. If there are none present, it means that I have a clear path, which means that I have room to my profit targets. This is what we're trying to do. So what I'm doing right now, Syed, is I'm saying this is what it looks like when it's time to sit on your hands. If price reaches an area and the triggers remain below, you've reached a termination condition. No more long trades. If price reaches a divergence high and the triggers remain below, this is the live market. Don't take a trade into it. It's likely to create a bounce. Guys, give me a Y if you can hear me, please. If price reaches Fibonacci support and the triggers remain above, don't trade into it. It could create a bounce. Nobody can hear me? Okay. One sec. One second, guys. We're getting there. Let me reconnect. Did it reconnect? I believe it did. There's my education room popping out. That's the wrong side. Can you guys hear me now? Are we good? Do we have volume? All right. Can you guys hear me now? Am I back? Guys, no volume yet? Still can't hear me? Give me a Y. No? Okay. I will have to reboot the room, which means that you will all be knocked out. Please return and we will resume. There we go. All right, did we get some volume now? Did that one work? Yep. Whew. All right. So we'll wait for people to get back in here. My apologies for that. I certainly don't like it when it happens, but it does happen sometimes. All right, guys. So why do we talk about termination conditions? Um, I just want to do this. So what if you had like a beacon in the night that said, "Hey, you're in a long position, you're in a short position. Where is that position likely to stop? Where is that position likely to lose momentum? Where is that market likely to reverse?" So when you start to identify termination conditions, guys, when you say to yourself, I don't have to trade into this red line because this red line could stop the market. I don't have to trade into these one-to-ones. These one-to-ones could stop the market. What it does for you is it keeps you patient. And when we talk about termination conditions, so there's a term you need to know. A termination condition is an area that can stop the market. How do I decide if it's likely? If price reaches that area and the triggers remain below resistance and above support, rule number 2 says don't trade into the area, guys. This is your safeguard. This is your whoopee. This is your I now know where the market has the potential to ruin my good time. I choose not to trade into it. So this is a look at 11 hours on crude oil before Thanksgiving one day, and 36 times the rules for rule number 2 kept you from taking a loser. 36 times. The rules were not met for a clear path, and if you chose to take the trade, it resulted in a loss. This is why we teach termination conditions. You see these lines long before you get to them. 10 times the area broke and created an opportunity to get paid. So trading isn't about being in every move. Trading is about having an advantage. It's about having an edge. Rule number 2 gives you the advantage of knowing when you should not take that next trade. Does that make sense, Syed? That's why we talk about clear path. These areas break a lot. This recipe, price reaches the area, where are my triggers? It develops patience. It keeps you from hoping that an area breaks, but rather it forces you to wait for the area to break. So right now, I'm not into an area, and I'm below an area. I have a clear path. Let's see what, and then here we go, even more so. Do you see how price made it to Fibonacci support? The triggers remained above. This is where you can make the choice not to trade into that blue area. You can make the choice, hey, that area could create a big bounce. It could reverse the market. I don't know what's going to happen, so I'm going to pump the brakes for a second, and I'm going to wait for the reaction. That's the magic of rule number 2, guys, and it keeps you out of a lot of shenanigans. When was the last time market was this crazy in 24 hours? Probably last time a Middle Eastern country got bombed, Sergio. Oil speculators hate big explosions in their oil fields. So if the area doesn't stop the market, guys, it means that it's breaking. This is what it looks like when it breaks. This is what it looks like when it stops the market, and then we wait for the reaction. This is what it looks like when it breaks. And this is a great little guide because if the market is coming down and it reaches Fibonacci support, like we just saw in the live S&P market, you have to ask yourself, where are my triggers? And if both small and large triggers are above that area of support in the moment is a termination condition. It's an area where I'm better off waiting for the reaction than I am trying to predict it. Can you guys give me a why if you're comfortable with number 1 here? Price bars come down and reach the area. The triggers remain above support. It's okay to wait for the reaction, guys. The futures markets trade billions daily. You don't have to be in every move. Well, if the area is going to break, your trigger lines will tell the story the same way they told you don't trade into the area. If your small triggers absolutely smash through the area, but your large triggers are lagging behind, This is what we call a 50-50 look. This is actually the second trade on the plan that I'm giving you. And what it means is that 50% of my triggers have broken through the area, 50% have not. And as long as I have separation of the triggers, as long as I have strong triggers, this area has the potential to break. That momentum gives it the potential to break. But it's not broken yet. So if I take a trade, I've got to be a little more cautious. I have to manage a little more assertively. The path is considered clear, and once again, the trigger lines will tell the story when the small triggers and the large triggers get below the area of support. Or if it's going up, once the large triggers and the small triggers get above an area of resistance. This is your look letting you know that the path is now clear. And guys, your path will remain clear until you reach the next area. So if we go back a couple slides, price reaches resistance and the triggers remain below, and in this moment I choose to pause. When the smalls break through but the large have not, I can say to myself this area has the potential to break, but it's not broken yet. Once the small triggers and the large triggers get above Fibonacci resistance, it behaves as Fibonacci support. My path is now clear all the way until I reach Fibonacci resistance. It doesn't mean that it's going to get there, but it means that there's nothing in the way on the large chart to produce a bounce. Price comes off of Fibonacci resistance. There's nothing in the way. I'm not trying to break an area. My path remains clear until I reach Fibonacci support. So what you're going to find is that as a brand new user, let it either be absolutely no trades or look for an entry. And it will open the door for the second one. It'll give you the ability to see the second trade, the one where the areas have the potential to break. Disclaimer, the easiest trades you will ever take, the less stress, the highest probability will come when you have momentum, separation between the triggers, and you have a clear path. Price has not reached an area yet. You have room to your targets. These tails are that refinement process on the small chart. You'll be able to pinpoint where these tails are most likely to form through the rules, through rule number 3 for the high probability trend trade. These are the easiest ones. Syed, make an entry when there is momentum indicated by the scissors and pause when the termination conditions are met. Perfect. I mean, you just summed it up beautifully. And what we're doing right now, Syed, is we're taking the individual pieces. We're taking recognition of momentum, and we're coupling it with understanding when a termination condition isn't met, and we're going to be able to take those two concepts, and you'll be able to find opportunities to enter the market with those two advantages. Does that make sense? I feel like we're on the same page. And I just drowned in my sip of water. There is one termination condition on a small chart. Up until now, the large chart has given us everything that we need. There is one formation that you're going to see on a small chart, and it's 3 divergences in the same price range. And these 3 divergences are just 3 losses of momentum. That's all it is. The sellers are in control. The buyer said, hey, we're stealing momentum. If they do it 3 times, 3 divergences can terminate a trend. This is the only termination condition. And that's where the word termination comes in, ladies and gentlemen. Terminate the trend. 3 divergences in the same price range may terminate a trend. And what it's doing is this is your small chart, that fast chart. It's giving you a little heads up because your large chart says down, it says strong, it says potential to break. But your small chart says, hey, pump the brakes just for a second. We're robbing the sellers of momentum, and we might push up a little higher. This is the only time, 3 divergences in the same price range, where I will choose not to enter the market on the small chart if I have the advantage of momentum and the advantage of a clear path. So far, so good, everybody? So Syed, the 2 concepts that we've spoke of, momentum and path, I want to show you this is exactly what your large chart is going to look like in a downtrend when those rules are met. The background is red. I've defined the direction of the market. The market is going down. I'm going to look for rules to be met to go down with it. Momentum has been established because the separation between the small and large, and there are no areas in the way. So This is what your chart looks like in a downtrend when the rules are met. In an uptrend, it's going to look very much like this. This is the indication that it's time to go to the small chart. It's time to go to the fast chart. It's time to go to that refinement chart. And let's pinpoint where the market is most likely to bounce and continue in the direction of all the large chart advantages. So let's go define an entry. Your entry is very precise, and it has a set of rules where language, I believe, becomes very important. So we're going to use a limit order to buy or sell a pullback at an area inside of triggers, which means that we're going to use a limit order. We're going to have some precision. And I'm going to use the big crowd, small crowd example. When the big crowd says up, when the big crowd says momentum, when the big crowd says nothing is in the way, we're going to wait for the small crowd to fight. And we're going to buy their pullback in an uptrend right at an area right inside of triggers. And it's so precise, we're going to use a limit order for this entry. So when everything says up on the large chart, you know what I'm going to do? We're going to go to the spreadsheet, guys, and we're going to go through the examples from the client trades. So for a long trade, the rules say I need momentum, rule number 1. Price cannot reach Fibonacci resistance yet, rule number 2. And guys, it's even coming from a termination condition that reversed the market. That's a strong bottom. It's not rules, but it definitely creates some warm fuzzies. So can you guys give me a Y if you see it? Momentum, have not reached the area. This area is no longer a concern. Let's go look for an entry. Anybody? Everybody? Nobody? This is what it's going to look like in the moment, guys. Price is trading all the way up here, 71.76. But Mark, there's a red line. No worries. Termination conditions are defined on the large chart. So once we have this look, the first step in defining an entry is we're going to wait for a reversal bar, guys. And this one down bar says, here comes the beginning of the pullback. This one down bar says, hey, guess what? The small crowd has begun their fight. This reversal bar is not your entry. This reversal bar says, let's go define our entry. So this is the beginning of your pullback. Once the reversal bar prints, you're going to be able to identify where the market is most likely to retrace by using trigger lines, large trigger lines. So you have large triggers, 2 sets on your small chart. These are the large triggers from the large chart, the ones with steps, we call those synthetic, and the large triggers from the small chart. These are smooth. And when these are separated from the small, you have momentum. So from the top of the triggers to the bottom of the triggers, this defines where the retracement is most likely to occur. Trigger lines are not your entry. They tell you where those down bars are most likely to go. But the rules say we are going to enter at an area inside of triggers. And that phrase inside is very important because we want to get in where the market is most likely to retrace. So the next step is identify the areas inside of triggers. First, we have the triggers. This defines where the entry is most likely to occur, or where the retracement is most likely to occur. And then we have areas inside of triggers, fibs, mid-bands, and yellow one-to-ones. The same way they create a bounce on the large chart that could mess up the trend, they create a bounce on the small chart that can help us continue with the trend. And from the highest point of support inside of triggers to the lowest point of support inside of triggers, this is your window where the market is most likely to bounce and continue with the large chart trend. We call it the window of opportunity. This is where the market is most likely to bounce, where it's most likely to continue. Because of the momentum, because of nothing in the way, you're going to activate a limit order. And you're going to activate that limit order a tick or two above the highest point of support, closest to the reversal bar. And now you're going to wait, hope, wish, and pray that the small crowd gets there. There's nothing else you can do, guys. This is how the accuracy of entry comes in, because you're calling your shot. You're saying, as soon as the fight is on, I know where they're likely to go. I know where they're likely to bounce. Come get me. This is my entry. And the great thing is This is a pattern. That's all it is. This is a pattern that you're going to be able to test. This is a pattern you're going to be able to prove creates more winners than losers when the rules are met, when the advantages are present. So when the large chart says up, when the large chart has a clear path, we're going to turn our attention to the small chart. Someone yesterday said, Mark, do we have to wait for the reversal bar to define our entry? And I said, no. Once you're good at this, you're going to start calling your shots long before that reversal bar prints. You're going to know exactly where you want the market to go to come get you. Remember, this is your first trade. This is the first trade teaching you to read indicators. Reversal bar begins the pullback. Where's the pullback most likely to go? Somewhere from the top to the bottom of the large triggers. That defines the retracement zone. Where's it most likely to bounce? Somewhere from the highest area of support to the lowest area of support. This is the window of opportunity. You're going to activate a limit order 2 ticks above the highest level of support and say, come get me. Syed, doesn't have anything to do with volume. We're going to use those areas inside of triggers. For a short trade, it's the exact same thing. We wait for the reversal bar, signals the beginning of the pullback. Where's the pullback most likely to go? Somewhere from the bottom of the triggers to the top of the triggers. But triggers are not our entry. Entries come from areas inside of triggers. And guys, there is one area inside of these triggers. I'm going to activate a limit order 2 ticks below it and hope they come and get me. And that's your entry. And the great thing is that what you have done inadvertently, by defining where the market is most likely to continue, you have defined where the market should not go, because rule number 3 shows you exactly where the market may retrace, might, could. It shows you precisely where the market is most likely to bounce, if this is going to be one of those winners, one of that 70 to 80%, which means that if you get beyond the retracement zone, if you get beyond the areas most likely to create a bounce, the advantage of rule number 3 is no longer in place. The advantage of rule number 3 has gone out the window. This is where the market should not go. That's where your initial stops are going to be placed, 4 to 5 ticks beyond the trigger lines. And it all comes together to create this pattern, guys. This is your high probability trend trade pattern. When I have momentum, when I have a clear path, guys, your large chart is a 1 bar scenario, and it is trading all the way up here at 97.05. Can you guys give me a yes? If you see the momentum, price has not reached any trouble, and we're above the previous trouble. This is your look. It's time to look for an entry. The top of that bar is also the top of this move. The rules say to wait for the reversal bar, guys, and we do this on purpose because from the top of this bar to trouble is $80 worth of profit. And for a lot of you, that's just not enough profit. The reversal bar begins the pullback, guys. The pullback, more often than not, goes to Fibonacci support inside of triggers and continues up. All of that retracement and continuation happens inside of that 1 bar on the large chart. So your advantages, those core advantages, never go away during the retracement process. And when you buy low, and Fibonacci inside of triggers defines low, that $80 turns into about $320 worth of profit potential. And because you know that your stop belongs where the market shouldn't go, you have the least amount of risk to go with the highest possible profit potential. So guys, this is nothing more than a pattern. If my rules are met on the large chart, I'll wait for an area inside of favorable large triggers on the small chart. This becomes my entry. This is the highest probability trend trade entry. The idea of tails on a large chart. We don't trade tails, guys. We don't trade the tails on the large chart. By the time they form, the market is all the way up here. We predict where those tails are most likely to form by using areas inside of favorable large triggers. And this, you can go back and circle these tails on a large chart when the rules are met. This is the S&P. So I'm going to circle this tail right here. It's historical. This has already happened. I'm nowhere near a live market. Can you see the momentum in this picture? So my newer users, Victor, Syed, who else is newer in here? Work with me. Have some fun. Play along. Do you see how there's separation? We're talking about this one bar right here. This is how you're going to study this to make it easier to slow the market down. Can you give me a Y if you see the momentum, if you see the separation, the scissors are open, whatever makes you comfortable to recognize that everything is red and there's space between the two. That's your first advantage. Okay. Price has not reached Fibonacci support. Just say space between. Keep it simple. Largest vertical space. Doesn't even have to be the largest, though. Thank you for saying that. I'm going to show you a quick picture. If you say separation is strength, and you allow it to be that simple, what you'll realize is that once the colors match and there's a gap between, your advantage is present until the gap goes away. There's not degrees of strength. There is separation or there is no separation. There is separation or there is no separation. Very black and white. There is separation. That probably hit a fib. There is separation or there is no separation. Let it be that easy. And then the same thing is true. Weakness means that there's no separation. No separation. No separation. No separation. It doesn't matter if it's symmetrical inside of the triggers or if it's only barely inside of the triggers. The advantage of momentum is gone. Does that make sense? I'm an overthinker too. So as long as the separation is there, I have strong triggers. Do you see how the small triggers have broken through these yellow 1-to-1s, but the large triggers haven't quite made it? Guys, we're hoping that all that momentum can break this yellow 1-to-1. When I circle the tail, I'm going to go back to a small chart, and I'm going to look at it. This is how we're going to study, guys. And it pulls right back to resistance, right inside of triggers, and it doesn't go 4 or 5 ticks beyond the trigger. So this becomes your pattern. Did anybody in the room take this trade? This was the S&P right around 955. Was anybody in that one, or were you pausing for news break? So what we're learning is this pattern. In the moment, this is what the market looks like. It is odds favorable, it is potential to break, and everything is screaming down. But as it plays out, you begin to see how the small chart creates fluctuations up and down, and all of those fluctuations on the small chart are happening inside of this one bar where nothing changes. So that's how we're finding our advantages. That's how we're capitalizing on these looks. I'm going to go back to the long trade. So I'm going to ask again, does everybody see the momentum in the move? Separation between the triggers. I have strength. I haven't reached Fibonacci resistance, and I have the potential to break this particular fib because the smalls are above and the large are below. This is the second trade on your plan. I'm going to scroll back on a small chart, and let's see what it did. It pulled right back directly to support inside of triggers. And ladies and gentlemen, this is your pattern. And if you go through the spreadsheet and look at the client trades, what you're going to realize is that the pattern repeats. Odds favorable, potential to break, pulls right back to a midband inside of favorable large triggers. Odds favorable, potential to break, pulls right back to an area of resistance inside of triggers. Let's see if we can keep finding them. These are all from the spreadsheet. It's the same pattern. Odds favorable, pull back to the area inside of triggers. So Syed, what we're learning right now, and Victor and all of you guys that are still brand new, is we're learning a very pragmatic way to trade a pattern that repeats itself daily. This is your high probability trend trade. It opens the door for a medium probability trend trade. But do you see right now, I don't have a clear path down. I don't have a clear path up. And guys, if you look at it, rule number 2 has kept you out of shenanigans for the last 5 or 6 minutes. You did take that one, Trina? Awesome. Can't wait to see it. So there we go. Exhibit A. Odds favorable, potential to break 50-50. You get in at the low area. Stop placement is perfect where the market should not go. And Trina, you capitalize all the way down. Absolutely outstanding. So what I teach every morning is being repeated by people in the room. Different time zones, different walks of life, different age brackets. It's just a pattern. The market doesn't know who you are or what you want, but the market has a memory. Trina, outstanding trade. So the first hour every day, guys, it's the exact same thing. Every day we talk about the high probability trend trade. My goal for you guys is to make it as easy as possible to build a foundation, to make it easy as possible for you to just really latch on to those first large chart advantages. And the easiest way to do that, guys, is to take pictures. And I created this because I discovered that a lot of people are hell-bent on looking for the money rather than looking for advantages. So I want you to start training your brain to identify advantages. Go take 25 pictures each. Strong triggers, weak triggers, clear path termination. Write the recipe for it on the chart. Let me pull up my spreadsheet. So when you take a picture of a clear path, I'm going to pull this one up. You're going to say small and large are below the one-to-ones. The path is clear until I reach the next area. So you're creating this correlation. What does it look like? How do I identify it? What does it mean to me? If you go through this process and do that for 25 examples of each, guys, you're not going to make the mistake of trading without momentum or trading in determinations. You'll be able to identify them. You may choose to do it, but it won't be because you don't understand it. As you take those pictures, guys, I'm giving you this high probability trend trade checklist. So this is your visual. This is your cheat sheet as you're taking those pictures. Do I have strong triggers? Well, this is always the strong trigger look. This is what it looks like when the advantage is gone. Do I have a clear path? Or is it a termination condition or only the potential to break? Guys, you're going to use that knowledge to know whether or not it's high probability, medium probability, or no probability. Defining the entry all the way down to where your entry goes. So as you go through and take those pictures, guys, use the cheat sheet. Make sure that you're taking the right pictures. Post them in the room. Ask me, hey, Mark, am I doing this right? And then the second page of this document is a spreadsheet for you to print out. And guys, this is going to pay huge dividends over the weekend if you're doing market replay. Because market replay allows you to go back and retest a day, to retrade it, to fix mistakes, to capitalize. And market replay has a pause button. So when you think the rules are met, you can actually pause it and go through this spreadsheet and make sure that they're truly met, which is a great way to study. But nobody in the history of this spreadsheet has ever been able to do worse than 70%. When you have momentum, when you have no terminations, when there's an area inside of triggers, this is a pattern that you can prove wins more than it loses. So as you're taking trades as a new user, write these rules on the chart every time, whether it's a yes or whether it's a no. And what it does is it starts to create that recognition for the good stuff and the stuff that maybe should be avoided. And this checklist is the core of the plan that I'm going to give you. And the plan that I'm giving you is called the KISS plan. And it's a stepping stone in your learning journey, guys. It's designed to optimize your chances of success with the high probability trend trade as a new user. Through simulation, study, class feedback, and continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Guys, when you can identify these advantages, you're going to see more trades. In the beginning, it feels like this. I know it feels like this. There's a lot coming at you. Learn how to keep it simple, guys. You'll end up growing your own plan. So define your entries, because great entries create very manageable trades. You're learning a lot. I like that. Now to put it in practice. Can I talk about how to manage risk? Syed, I love it. You are in my head today, and you're 2 steps ahead of me, which is outstanding. Because what we're going to talk about is by defining your amazing entry, you're creating and managing your risk. And you probably understand that successful traders manage their risk long before they ever manage their profits. And you're already managing risk by insisting on momentum because it's going to be hard to stop that market. And you're managing risk by having a clear path because it's with nothing in the way and all that momentum, it's going to be hard to stop that market. And you're managing your risk by entering the market where the market is most likely to continue. And once you take that outstanding recipe for an entry, you have to manage it. So, on this plan, I've given you the most pragmatic, emotionless, if then approach to managing trades that I could ever come up with. Because truth be told, and guys, I hate to tell the truth when it makes it look like I'm not brilliant 24/7. I was horrible at management in the beginning. I was terrified. Every time I took a great entry, I was so scared of losing money that I couldn't let the great trade play out the way the great trade needed to play out. So the management in this KISS plan is designed to do two things. It's based on two contracts. It's designed to help you understand stop placement because it's important to understand where the market shouldn't go. Risk is a part of trading, and understanding where risk belongs can help you avoid larger losers. But this plan is also focused on getting you paid. Has anybody held a trade so long that you gave it all back? Or has anyone jumped out of a trade so soon that you just didn't make anything on it? I've done both, about 1,000 times each. So when I realized that management was one of my problems, this is when I wrote this. This was for me. This was my own personal, get your head out of it and let it be mechanical. And that's what this is. This is an if-then. But you will create your own plan, guys. And it'll be based on your ability to read the indicators. But until you can do that, it's okay to let it be really mechanical. And this is 100% if-then. And if your entry is 2 ticks below resistance inside of triggers, the high probability trend trade entry, then your initial stop is 4 to 5 ticks beyond the triggers. This is where the market should not go. And let's talk about why it shouldn't go there. Because if I have momentum, if I have a clear path, and the market pulls back to the area inside of favorable large triggers, this is a pattern that I can prove wins more than it loses. Well, I've defined where the market is most likely to retrace using the large triggers. I've defined where the market is most likely to bounce using the areas within those large triggers, which means that I have defined where my advantage is no longer present. This is where the market should not go. And you will know your risk before you ever enter the trade. Because 4 to 5 ticks above the triggers is always 4 to 5 ticks above the triggers. So when I take this trade, my stop, I enter at 71.34. This is crude oil. My stop goes at 71.49. And that's $150 per contract. That is $300 worth of risk on this trade. When you trust the methodology, you're not worried about $300 of risk. But as a brand new user, it's terrifying. That's half your car payment. So if as a new user, you choose to alter the plan, and you say, well, I'll give it $50 worth of risk, you're still at areas where the market may go and bounce. If you say, well, I'll give it $80 worth of risk, you're still in the retracement zone. So I encourage you guys to keep it very, very mechanical in the beginning. Let it play out. Let it do what it's going to do. You're on simulator. If my entry is at 71.34, then my stop is at 71.49. Targets are predetermined, $100 and $200. And they're either going to stop you out. It's a normal part of a positive equity curve. Anything that wins 70 to 80% of the time will get stopped out 20 to 30% of the time. If it does not, it means that you're going to get a reversal bar in the direction of your trade. It was a reversal bar against your trade where you defined your entry. It's a reversal bar in the direction of the trade that defines where your new stop goes. So if a reversal bar prints in the direction of your trade, you will redefine where the market should not go. and your new stop is 2 ticks above that reversal bar. Why is this where the market should not go? Because the market is confirming. It is now going down with momentum. It's going down with a clear path, and it's going down from the areas most likely to create the bounce. Guys, if you try to anticipate a reversal bar, very often you're going to get caught. Let it print, let it finish. Targets are still $100 and $200, but now you have $30 of risk on this trade. You're either going to get stopped out for a small loss, or it's going to go to your first target. And the first target is $100 away from your entry. $100. That's it. Oh, volume's gone. Really? Arg. Let's do this. Hold on. Mute. Close. I'm coming back, guys. I did a little reboot. I'm hoping that it all works out. Let's see if I can reconnect. Let me open it up and see. I don't know why it's always so hard to get back. One second, guys. Hopefully you can hear me. I don't know if you can. There we go. Did we get some volume back? All right. Did we get volume back? Are we good? Can you hear me? No volume. And come back to you. I'm so sorry, Discord glitch. Please return to the room. I'll be back in 1 minute. Hi, baby. All right, can you guys hear me? I'm so sorry. I'm trying to bring everything back, and then I almost wiped out doing it. Are we there? We're good? Okay. Whew, man, I'm sorry. Discord does this every now and then. I apologize. That was the Iranian cyber attack on Discord. It must have been. All right, guys. So let's get back into management here. I want to make sure that we have the people that need to be here. Syed said still no joy, but we're in. We're back. Syed was asking about management. I hope he comes back. And where are we? We're at a point to where the reversal bar prints, guys. That reversal bar is amazing. And then we hit our first target. And if you hit your first target, guys, you're successful. That's a win. And that first target being hit means that $100 goes into your account, and you're going to move your stop to break even, and you're going to have zero risk on a trade, and you're going to have money in the bank, and guys, that is where we start to develop trust. The break even stop is nothing more than a way to remind you that with odds favorable momentum and a clear path, this market is more likely to go down than it is to go up. It's more likely to finish the move than it is to just arbitrarily turn from the middle of nowhere. It doesn't mean that you won't get stopped out break even. Very often you will, but $100 is still a pretty good moment. But if it doesn't come get you, you end up at the $200 target, which means that you just took a $300 trade. And guys, a $300 trade is a pretty outstanding trade. $300 is a great way to make a living if you do that 2 or 3 times a day. Because $300, if that's the best you do, is a $75,000 a year. I encourage you guys, learn how to make $200 to $300 a day. Learn how to be consistent. Learn how to shut down when you've made it. Because you can make an outstanding living on $400 a day. You can make an even better living on $500. And once you can make it consistently, guys, you're going to find that it's easier to make more, that it's easier to compound, that it's easier to add contracts instead of just adding more trades. There's people in this room that have 1 or 2 trades in their plan, and they take it with 4, 5, 6 contracts, and they make $1,000 a trade or $500 a trade, and they shut it down and they go play golf. And that's kind of the goal, guys. Consistent money gives you the ability to do this. So we've gone through the first hour. I hate that I lost Syed because he's brand new. And one of the things that I tell you guys every morning is that I'll give you everything you need to be successful with the software. The one thing that I don't say is that I'll give you everything you can do with the software. Because the reality is that you guys come up with amazing ways to make money with the software. You guys see patterns outside of the patterns I teach, and you're finding a way to capitalize, and you begin to recognize things through your chart reading. And I wouldn't ever want to tell you that this is the only thing you can do. This is your foundation that makes it easier to do the other stuff. So you've gotten the rules for the highest probability trend trade you could ever take. I've broken them down individually, and I'm going to give you everything that you need in the zip file so that you can capitalize and learn it and practice it. That's the Chart Reading 101, the High Probability Trend Trade Checklist. It's the KISS plan. It's my PowerPoint. It's everything that you've gotten in this first hour rolled into one zip file. The only thing that you don't have is seat time, or time on the pond, as Pete says. You don't have the experience for this to be easy yet. And that takes a little time, guys. It really does. So as we get into the second hour, what I really want you guys to understand is that everything about this class is designed to build a foundation. Everything about this class is designed to give you a core set of advantages that you can grow from. And pretty conservative rules. Hey, look, termination condition. Teaching you to recognize advantages, helping you understand when you have an edge. And as we get into the second half, you're going to see a lot of people taking their ability to read charts and finding opportunities that don't match up with what we've just talked about. Instead of becoming the trade police, what I really want you guys to do is say, wow, this is where I'm headed. When I learn to read my indicators, this is where I'm headed. This is what I'm going to be able to do. And there's so much opportunity if I just learn to read my indicators. So don't be the trade police. Be excited about watching people making money with this software, understanding that that you're headed that way. I'm sorry. I wanted to let Syed's client advisor know he's not back. So The second half of class, guys, is dedicated 100% to your chart reads. It's dedicated 100% to what you did, what you saw, what you need help with, what you're working on, and what I can help you with. So every chart that's presented in the next hour or so, um, I'm going to go back to momentum, path, and entry. I'm going to go back to momentum and path and entry, whether it is a high probability trend trade, a medium probability trend trade, a counter trend trade, a momentum trade, a just jump the fudge in trade, guys. I'm going to go back to these three ideas, and we're going to look at chart reads. Some of them are going to be outstanding. Some of them need a little nudge in the right direction. It's okay. I'm not going to grade you on your chart. I'm going to talk about advantages, disadvantages, what I see, and if there's a way that I think you could do it better, I'm going to give you everything that I have to help you do it better. So I won't be the trade police if you guys don't be the trade police. So I'm going to scroll up to the top of the room, and I'm going to start clicking on the charts that you guys have posted. And man, we've got a lot of comments in here, which I absolutely love. And there was tons of discussion this morning before the classroom ever started. That's one of my favorite things, is when you guys get all chatty Cathy in the morning looking at stuff. So Wayne posted a lot last night, and Wayne will post these in the room even when he's not going to be here, and he'll come back and look at YouTube. So I always want to make sure, guys, if you post after hours, post it up. If you can't make the class, what's pretty cool is I'm still going to go through it. Are you in here, Wayne? Oh, right on. I didn't see you. It's not showing me everyone that's in here for some reason. So good. I like that you're here. So Wayne says, check it out, Mark. This is how I read my charts. I see a high probability trend trade. I recognize that I have a clear path, smalls and large are below. I have odds favorable momentum. There's still a separation between the triggers. So Mark, I'm going to go ahead and sell the market right at the mid band, right at the top of the triggers, and I'm going to make some money on the way down. KISS targets 380. And Wayne, this is about the nicest trend trade you could ever take. So I'm going to take it. I'm going to copy your link, and I'm going to open this bad boy up, and I'm going to go to the user trades, and I'm going to put you in the Hall of Fame, because honestly, I want everybody that comes behind you to be able to look what you did and find a way to do it like you did. So we're going to call it VCP Wayne Perfect Trend Trade Short. Boom, and now we have one more in the study guide. We're going to come through again, and now we don't have odds favorable momentum. We've got anything can happen triggers, and we do have a clear path, and we don't have an area inside of triggers. So guys, the chart read is, hey, guess what? I don't have two of the things that I need out of the three. So Wayne resorts to his chart reading, and Wayne says, okay, let's see. I'm coming from a strong top. Everything is screaming down. I've got room to the next fib, but I don't have the perfect entry. You know what I'm going to do? I'm going to see if that mid-band holds and creates a bounce before I enter, and Wayne catches it on the way down. This is taking his ability to read charts, to understand these patterns, and to modify his entry a little bit so he has a place to put a stop. And he still takes it all the way down. He says Wayne met his daily goal between two fibs in under 4 minutes, trading the same look, the same pattern. Outstanding, Wayne. Momentum, path, you just jump in, and it doesn't go the distance for you, Wayne. And this is what I love, is Wayne says, I'm going to jump in with momentum, and the momentum is my advantage, and I hope it takes me up here. And then when his momentum fades and he gets that reversal bar, do you see how it turns into the perfect trend trade? Wayne understands that when momentum trades fail, if the large chart is momentum and clear path, that's the most likely outcome. So he just stays in the trade, lets it bounce, gets paid right where he wanted to get paid. Wayne, this is awesome understanding of what kind of trade you're in and what kind of trade it can produce. And this is just expert chart reading. Really nicely done. And he's right. He could have added on to that position as a high probability trend trade. All right, next trade. He has a strong trending market, which means that the market has pushed at least 30 bars, in the same direction, and there's nothing in the way. So Wayne has a strong trending market. When you have a strong trending market, you can say to yourself, all right, momentum is assumed. Path is clear. He has strong triggers on his range chart. You almost have strong triggers here, and you get in for the momentum. And Wayne, your momentum goes away, but you choose to hold it, and you're able to get paid. Quick $110 profit. And he says he miscalculated his entry by a tick. That means Wayne was waiting for the back of the bar to clear this area to get price away from that decision-making zone, and he just jumped the gun just a little bit. And there's the bounce that punished him for it. But Wayne knows his trade, and he collects. Nicely done, Wayne. Holy busy, Batman. You tried a long trade. Odds favorable, clear path, and the only thing that this trade didn't have, Wayne, and I want to know if you noticed it. So your entry area was on the wrong side of the triggers. Rule 3 not met. That's it. That's the only thing, that's the only challenge with this trade, is Wayne has momentum, he has path, but he doesn't have anything bouncy in the retracement zone. And Wayne, this one does create a bounce, and I like your entry. You catch it on the way up. I don't know if I would have kept so much risk on it, because once we get back below Splitsville, and here's the awesome thing, is Wayne said, this is a good look. I'll take a shot. I know where my risk belongs. But if this fails and I have momentum the other way, I'm just going to go down with that momentum. And that's exactly what he does. It's like did and does when you mix it. And there it is right there. This one didn't work, but everything is strong down. Let me go down. And then the market was moving fast. And there's that idea that momentum in, momentum out. But easy 210, recover the loss. Great heads up. Momentum on all three charts. Wayne says, I'm going to go down with the momentum and take it to the fib. Once again, momentum and path. Trading to the areas rather than into the areas. Outstanding, Wayne. Everything says up. There's nothing in the way. Wayne gets in, goes up, makes money. I mean, momentum, momentum, momentum. Path, path, path. Momentum and path for the win, ladies and gentlemen. You see it a lot. Is it a high probability trend trade? Of course not. There's no pullback. It is a market screaming in the direction of the trend with nothing in the way to create a bounce, and Wayne finds a way to capitalize. Great job, Wayne. Calls it a trend trade. I'm going to disagree respectfully, because a trend trade comes from an area inside of triggers. What you did is you said, oh no, I didn't get my entry, but I have momentum and path. I'm just going to see if it does what a trend trade does and continues up. And you get in pretty late on it. You take some really quick profits, and you're out break even. Sometimes it's not your money. And Wayne, I suspect, based on my own history as a day trader, I suspect that you were previously occupied on that perfect trend trade. And when this one didn't show up, you said, dag nabbit, I can create expectations based on it. I'm going to get in late, but I'm going to make sure I get paid. I'm starting to get divergences, and I'm going to get to break even because things seem to be changing a little bit. I'm losing momentum. I'm printing divergences. I'm outside of the outer band. Dude, it's a great late entry and awesome management coming into it. Nicely done. Missed the target by 2 ticks. Yeah, and because your target was just a number, right? The sellers had other ideas, and none of your charts gave any indication that that market was going to do what it did. Was there a line? I don't see one. You must have seen one that I don't. I don't have a line on the large chart. I don't have a line on this chart. Was it off? Was it off camera? Exit stage left. I believe you. It's just not in the picture. Great stuff, Wayne. Great trading. And guys, you'll notice that most of his trades, actually I would say just about all of his trades, revolve around momentum and path. And then he's finding a way to make money. Once he determines momentum and path, he's able to capitalize, able to take advantage and to make some money. All right, Cav says, got in early, should have waited, hung on for a big profit. So Cav jumps the gun, right? And then once his large triggers roll, it becomes easy. And I agree. You jump the gun a little bit. And honestly, you're trading directly into one-to-ones that could have created big problems. And they did. And that's where the trade should have been placed. Nice hang on. Little spooky, but a nice hang on. And then the long, I don't see the long, Pete. And then when everything reverses, you try to go long. Oh, there's the long right there. So your long is at 351, 351. Everything is going up, but you're losing momentum from the wrong side of the triggers. 2 rules broken. When you go back to the core, 2 rules broken, right? 2K last night in bed. That's awesome, Wayne. So I don't have momentum. And it doesn't look like, well, you do have a clear path, but no entries inside. And Wayne says, or I'm sorry, Pete says, well, I don't have an area inside. If it starts to go up with this look, I'll go up with it. And he takes really quick profits because it's a little more lower probability. And then he hangs on and waits. And then Cav, that's what you saw. And he gets in on the way down. He takes the easier, less stress. All the momentum, nothing in the way. Easy profits. Nicely done, both of you guys. And let me scroll up 3 miles and get to the next pictures. And guys, just a reminder, I have to go from the bottom to the top to the bottom of the top. So I'm racing back to see any questions or comments that you guys have. If I ever miss something, let me know. Don't let me get away with it. It's never intentional. Pete. All right, so we have 2 for Pete. We have, oh, we saw that one. Sorry. And then this one, 2 examples of oils not respecting divergence rules this morning. Every time you get 3 bounces right back and blasted through them. But that's okay. That happens. Guys, 3 divergences, and let's say this real quick. 3 divergences in the same price range. 3 divergences in the same price range. It may reverse a trend. It might reverse a trend. It could reverse a trend. It has the potential to reverse a trend. It didn't break any rules. Everything on your chart set up. You had strong triggers. You had everything screaming up. The sellers tried 3 times, and they just failed. The sellers tried 3 times to stop that market. You see it on a small chart. They failed. Look at what the large chart looked like. Guys, don't put all your eggs on 3 divergences. If the market's really going to go down, you're going to see some change. This is enough for me to say, okay, I'll let it break, and then I'll look for the long trade. But sometimes it doesn't. More often than not, it does. But remember, the small chart rarely wins out over the large chart. That's a great picture. Because what Pete's doing is Pete's saying, hey, this market's acting a little crazy. Things are blowing up. Maybe I need to be very conscious of my rules. Maybe I need to manage a little more aggressively because the market doesn't seem to be flowing those patterns the way it usually does. I like that recognition. That's experience, guys. That's seat time. Learning a market's personality a little bit. Doesn't mean go long or short. It just means, hey, pump the brakes and pause, right? All right, Paul. Let's see what you did, my friend. Um, Back to basics, right? Large charts losing momentum, and you're on the wrong side of the large triggers. Small charts losing momentum, and you're on the wrong side of the large triggers. Next chart, no entry areas inside of triggers. You're below all the triggers here, and you are below all the triggers here. So Paul, this is, and again, I like to go back to two charts on your trades. I've got 2 out of 3 things going wrong with this look here, right? 2 out of 3 things. It's okay to not take the entry. Now, Paul, you had a great observation yesterday. When might you take a chance with this one? How about when this chart is odds favorable momentum in the direction of the trend? You pointed that out yesterday, that when this chart is screaming up, that 21.3, that bigger time frame. Guys, can you give me a Y if you hear me? No sound again. Anyone? Nobody? Oh, you do have me. Jen, am I back for you? Okay, cool. I didn't do anything. I just got lucky there. So, Paul, I think you had an awesome observation yesterday that when that 21.3 is screaming, it's hard not for it to go up and finish the move. And once it gets weak, that may change the outcome a little bit. Over here, we have divergence, not quite momentum on the large chart. Small chart has odds favorable momentum to the downside, and you fight it, and it doesn't work out. So no momentum, wrong side of the triggers, didn't work out. Fighting everything on this chart, fighting this chart, didn't work out. Odds favorable momentum, everything screaming up, and I'll be damned, it was pretty easy to make money. Pardon my French, ladies and gentlemen. This is one of the greatest things about repetition, right? So, Paul, John Novak would ask me in this situation, how many times are you going to fight everything and lose until you just start taking the easy ones? And there is no answer. We're all different. When John Novak asked me how many times I'm going to trade into termination conditions before I get sick of losing, I told him I'm done with it. And it turned out the answer was 72 million because I just formed opinions. There's something to be said for momentum, right? And man, Paul, you're proving it. You're proving it that when that large chart has strong triggers, it's so much easier to make money. But you've got to go through trying everything before you focus in on the one thing that's making you money, before you focus in on the two things that are making you money. So great pictures. Great pictures, Paul. And then I took these pictures, and I think these kind of go in line with what we're sort of talking about. So one of the things that I hear a lot is my rules were almost met. My rules were close to being met. I didn't have momentum, but, right? And this is what it looks like on a continuation trade. But there's no areas. And guys, my large chart doesn't support it. And if you almost have your rules met, it's less likely to win. And if you almost have your rules met, it's less likely to win. And I was blowing out I was blowing out simulator money this morning to make great pictures. But what was cool is that when I said, hey, look, this was a 50-50 trade, the potential to break, but it was from a weak top. The small chart tried to talk me into it, but the rules said that this is less likely to work. Jen posted a minute later, there's a loss of momentum and the market reverses. No termination, it's a bad top. And she says, but I do have odds favorable momentum, and I do have an area inside of triggers, but didn't take this trade because of the bad top. And guys, this is the difference between successful traders who choose to do nothing without an edge and the people who struggle who say, well, it's almost good enough. Jen, I think that was the most timely post. I can form an opinion and hope that it works, or I can follow my plan and avoid the loss. Great picture. And that's both sides, right? That was both sides. Losses are one of the most amazing things that can happen to a new trader. Not winning is one of the greatest things that can happen to a new trader because it reinforces that your rules really do create an advantage. Your rules really do set you up for success. This was another one, guys. We're just going to do this because I was taking pictures of chart reads. Price reached Fibonacci support and the large triggers were a full bar away. This is what we call the gap theory, and price is more likely to close the gap to the large triggers than it is to continue down. And I even circled the large triggers. I said, let me use a pattern to try to call my shot. And guess what? I'm saying, all right, there's nothing to do. Let's see what happens. And sure enough, it closes the gap to those triggers. And then I remind you guys, if you're trading in determination conditions, guys, if you're taking chances, if you're hoping and wishing and wanting, we need to talk about why any short trades you took there is less likely to work. Because this was an avoidable loss if you took it. I love it. I love taking pictures of patterns, guys, because the market has a memory, and when you start to get in tune with those patterns, it's like having a magic 8-ball. It's like having a crystal ball. You see it, you know it, you recognize it, and you choose to respect it, and it's pretty cool. And Pete says, man, rule number 2, keeping me safe. Can't make up its mind what it wants to do. I'm going to sit on my hands. I'm going to wait for my indicators to tell me that I have an advantage rather than hoping the market does something that it's not saying it's going to do yet. Good stuff, Pete. Great picture. And then Bob says, while you guys are partaking in shenanigans, let me show you what the patient traders are doing. Let me show you what the guys with a little experience are doing. Bob says, odds favorable momentum. It's already formed. His areas have the potential to break. Bob takes an entry right at the area inside of triggers. Initial stop where the market shouldn't go. And Bob makes money. Great trade, Bob. And then he gets odds favorable. And everything says up 50-50. And Bob takes another entry and makes money. And then he still has momentum and a clear path. And Bob gets in 2 ticks above the mid-band and holds for the fib with all the momentum. And Bob, you have the Expert Trader Award this morning. Pretty amazing. Nicely done. Just double dipping. Entry paid, entry paid, entry paid. What a great display of what you can do with the software with a little bit of study. One more for Bob. Bob says, well, I'm tired of making it up. Let me make it the other direction. Odds favorable, 50-50. And Bob says, I'm willing to take a shot. 2 ticks below Fibonacci resistance, mid-band, and he gets paid. Everything goes down. Bob gets in again. Gets paid again. I mean, come on, Bob. Can it really be this easy to simply let momentum lead the way and then just find an opportunity? How long does it take to recognize that? Remember a month ago, Bob, when you were taking every twist and turn like a madman because you had to make money? Is this easier trading for you? Is this less stressful? And I would wager to say it's more money than you were making trying to find all the trades. I love it. Great job. Great job. We can all learn something from Bob. Bob, I might need you to teach a class. Might need you to teach a class. All right, Ron, let's see what you did. Ron says, with the smalls inside price, he waited for the retrace to the fib. It's on the wrong side of the triggers, and he gets in on the way down and rides it. He has path, doesn't have momentum, And since he doesn't have momentum in the areas inside, he says, let's see if it hits the fib. And I want you guys to see how language pays dividends real quick. I want you guys to see how language pays dividends real quick. When we learn termination conditions, the way we describe it is price reaches fib resistance. Where are my triggers? If below, resistance may stop the market, right? That's it. That's the whole recipe. If price reaches Fibonacci resistance, resistance may stop the market. Well, Ron identified resistance here and here, and Ron says price pulled to resistance. All my triggers were below and angled down. This is an area that might stop the market, could, possibly. Let me wait for it to go down. Give me an indication that that's exactly what it wants to do, and I'll go with every trigger line and get paid. Nicely done. Guys, that is the understanding of rule number 2, creating opportunities. Great job, Ron. Weird to see you take one of these trades. But once you understand the high probability trend trade, you really do start to see the rest of the entries. You really do start to see the rest of the advantages. All right, Bob, same trade. Lost momentum, triggers weakening, but you have a clear path. And since the area is outside of favorable large triggers, you waited for the confirmation bar. And down it goes. So everything that I just said about Ron's chart, Bob annotated on his chart. Took the exact same trade with the exact same entry and made darn near the exact same money. Great job, Bob. Bob, I feel like you are student of the day so far. Not that I pick favorites, but Bob, you're totally my favorite. Don't tell the other people. Just kidding. I love seeing you guys find success. So Miss Jen says, check it out. I'm losing momentum, but I still have. And if this thing keeps going down, I'll ride the momentum down, get paid. And Jen, I'm not sure. Can we talk about management, Jen? Would you like it? Jen says she jumped the fudge in. So I'm going to do this. You didn't screw it up. You created an awesome lesson for class. I owe you one. Jen says, because of momentum, I'll enter. Jen says, and I'm just putting words in your mouth, right? If we were married, I wouldn't tell you how to think, but I'm going to do it because I'm across the pond and it's internet and you can't get to me. Jen says, if momentum is my reason, loss of momentum is an outstanding reason to exit my position. So Jen gets in, and she gets paid quick because she knows that momentum's the only reason. And then she gets a reversal bar on the wrong side of the triggers, and that's her loss of momentum, and this is an outstanding exit. Well, Jen's also a great chart reader. And one thing Jen knows is that when the conditions are perfect on the large chart and the rules are met on the small chart, very often a failed momentum trade turns into a beautiful trend trade. Does that make sense, everybody? When it's perfect, that little reversal bar pushing back to an area inside of triggers, Wayne gave us an awesome example of it earlier. Let me see if I can find what it looks like in the perfect scenario. Because there's two options here. The first option is, my goodness, you guys have posted a lot today. Let me find that picture, Wayne. There it is. First try. So the first option is if my momentum trade fails and everything is perfect for a trend trade, perhaps I'll hold on to that failed momentum trade because I know that I have areas inside of favorable large triggers. Does that make sense? So when this one dies, it turns into a trend trade because the rules are met 100%. When this one dies, I don't have my rules met Great reason to take an exit. Awesome reason to hold the trade. Does that make sense, everybody? So if your momentum trade fails and everything is perfect for a trend trade, what a great reason to hold on to that trade. If your momentum trade fails and you can't find the rules met for a trend trade, it's okay to exit. So Jen, I don't think that you screwed up. I think you and Wayne tag teamed this one to show two very different scenarios when a momentum trade fails. One of them says, yeah, let's hold it and see if it turns into a trend trade. The other one says, damn it, I can't find rules met over here. I might as well exit and just wait for a better trade. Nice job, both of you, on that one. And Wayne says, high probability trend trade of the week was 85.24%. 15 of 17. 50-50, 4 for 4. Chili Dog, 5 for 6. Jump the Fudge in, 8 for 10. The common factor on all trades was momentum and path. Thank you for saying that, Wayne. When you take the fight out of your trading, guys, when you take the fight out and you go with the flow, trading becomes easier. And Jen, I know that you know that lesson, but I think it's a great lesson for the rest of the classroom because a lot of you are trying to jump into the market and you're holding these trades way longer than you probably should. And that maybe gives a little guidance on how to manage. Let me see where we're at. And then Pete, man, let's celebrate. Pete passed his account on the Nexgen Pro Trader funding. Congratulations, Pete. You are in the core of the beginning of the people taking advantage of this. I can't wait to see you do more great things with it. Isn't that awesome? All right, Cav, good bottom, strong triggers, potential to break, pulls back to support inside a favorable large trigger. Well, inside of triggers, right there, easy money. Cav, great trade, man. Great trade. And then Miss Trina, I think we already sang your praises for this one, but I'm certainly not afraid to do it again. Odds favorable and the potential to break. And Trina says, and Trina, I want to revisit this one because this is such an awesome lesson on the phrase where the market should not go. Trina says, check it out. I'm going to get in 2 ticks below the lowest point of resistance inside of favorable large triggers. I'm going to put my stop 4 to 5 ticks beyond the triggers because this is where the market shouldn't go. Trina takes an entry and gets paid because she understands stop placement, because she stuck to the plan rather than saying, oh my gosh, this is too much. Trina, on a 50-50 from a weak top, you're pushing it a little bit, especially with divergence on the trade. And I don't know what your rules say about divergence. So I'm going to turn it into maybe a lesson that you don't need. Guys, a weak top decreases the likelihood of success on a 50-50. Divergence exasperates that likelihood of failure. Does that make sense, everybody? Because it takes momentum to break areas. This is your first sign of momentum losing. For a lot of you, it's not a deal breaker. That's cool. But one of the things is if divergence is an indication that I'm not going to take this trade. So Trina, if you're like, if divergence prints or Jen or Bob or anybody in the room, divergence isn't true until about right here when you're already at the area. So what it does is it says, okay, I'm going to wait for divergence and I'm going to wait for it to either be true or false. If it's false, I'll hop in. If it's true, well, it may push up higher. I might wait for a reversal bar. So when they're really, really close like this, and I love everything about this trade, don't get me wrong. If divergence is one of your rules, ladies and gentlemen, you can't take this entry because you have to wait to see if it's true. Does that make sense? And it may not even apply to what you're doing, Trina. I think you were going to take that trade no matter what, and I think that you were putting your stop in the right spot no matter what. But if that is one of your rules, if you're following the KISS plan verbatim, you have to pump the brakes and pause just a little bit and wait to see if that divergence is true. It's a great trade. And I love your understanding of stop placement. All right, let me see where we're at. Two turntables and a microphone. All right, Cav, let's see what you did, brother. Cav says, Mark, I want you to see this. And Cav, can we turn this into a NASDAQ lesson? For you guys that trade the NASDAQ, NASDAQ is a different animal because this is a 34.5, not a 13.2. This is 4 times bigger than what you're accustomed to for a large chart. Your small chart is the large chart on any other market. So Cav, you have momentum. Where's 81? All right, so we're looking right here about you have momentum and it looks like the potential to break and you're ready to take the trend trade. So Cav, there's 2 possible entries. The first one is getting in at the area. The second one is trying to get in on the other side of the triggers. It looks like you tried to get in on the other side of the triggers. If the large or the small triggers are a full bar away, Cav, on the NASDAQ, your advantage comes from getting in at the area because what it does is it gives you all of this room that if those triggers are going to hold, you can manage it because it's virtually no risk. Now, the opposite is true. If those small triggers are really, really close, less than a bar away, they can behave as support or resistance. And there's another one right there where the small triggers were so far away, it gives you time to manage. And that's just a NASDAQ trick, guys. But that is, I blew out so many accounts fighting those small triggers on the NASDAQ. I think it's a really cool lesson. And it's not, and Cav, the timing is difficult. It takes a lot of practice to be able to time that out because of how fast the market moves. But this is a beautiful trade, no matter where you get in, because it's nothing but down, and you just kill it. Nicely done. All right, Paul, we've got 2 more from you. Let's see what we have. I love sound effects. I don't know if you guys knew that. That trade lasted 2 seconds. Nicely done. All right. Odds favorable and the potential to break. Strong triggers, I like it. Weak triggers and weak triggers. So let's talk. I like this. Lightning bolt trade. Yeah. All right. So Paul, this one says, hey, we definitely have potential to go up. I wish I could get all of these on the same screen. I'm going to try and do it. And look at this. You left me a spot to annotate. So your 21 says odds favorable, momentum, and potential. Your 13 range says odds favorable, momentum, and potential. Your 13 says weak but clear, and your 5-1 says weak with areas. And this is one of the things that I had to do a lot because I tried to incorporate this really large chart in. And I'm going to go back to the idea of 50-50 trades, Paul, and let me know if this makes sense. And this is just too much information. Shut me down, please. So when we talk about a 50-50 trade, let me open up the KISS plan. One of the things that we do is we're saying that the large chart isn't perfect, right? And that's the easiest way to say it, is my large chart isn't perfect. It only has potential. And because my large chart isn't perfect, it only has potential, the idea on being able to capitalize on it is that your chart and area down is perfect. And when you look at the KISS plan, it talks about a strong top or bottom and momentum and no divergence and all those things that make the entry chart perfect to capitalize on an imperfect large chart. Does that make sense? It's a trickle down. This is a maybe, so I need to force this to be perfect. And what happens is this is a maybe, but this isn't perfect. And this one actually happens to be a maybe. So the trickle down is, well, I don't have the momentum I need. My smalls are inside of the large, right? And then divergence prints again. And what happens is if you just use trickle down economics, if this isn't perfect, force this one to be. And if this one isn't perfect, it's okay to not hope the small chart puts you in something. And that's where it kind of gets a little gray when you start adding in the extra charts. If you lose the extra charts, here I don't have the best momentum, but I do have a clear path. And if I chose to enter at the area inside of triggers right here, hold on, didn't mean to use that one. Check it out. If I wait for the pullback to support inside of triggers, it creates a little bit of a manageable trade. And then it comes back to the areas inside of triggers, and once again, it's a manageable trade. Rule 1 not met, Rule 2 met. One not met, 2 met. Rule 3 met, take and manage. So again, we go back to the 2-chart read. I would start to get confused when I have strength and weakness. But honestly, 2 charts, I have the advantage of a clear path. I don't have the advantage of momentum. Here's my pullback directly to support inside of triggers. This loss of momentum says we may push lower because I don't have momentum anywhere, and it does, right to the bottom. And then it starts to head up, it looks like. And I think that might be this. Is that this one over here? Man, Paul, I may have just screwed up that entire lesson. I may have screwed up the entire lesson. Because you were here. So your large chart was potential. This was potential. Okay, so you did have strength, and that worked out. I'm so sorry, Paul. I confused the two. I do this sometimes. There's 4 right here. Odds favorable, potential to break, pulls back to support. I love this trade. Stop placement doesn't make sense. Man, Paul, can we scratch everything I said and start over? Odds favorable, potential to break. Perfect entry, maybe just a little bit high. Stop needs to go where the market shouldn't. Creates a very manageable trade. Odds favorable, potential to break. 1 divergence. Pull back to support inside of triggers. Stop where the market shouldn't go. Makes a very manageable trade. So the first one's a rock star. You're just not waiting for Rule 3. And I apologize. Yeah, we are. Dude, this is a great trade. I think just a little small chart patience. And then the second set, there we go. This is the one. Odds favorable, potential to break. Weak triggers, and then your entry, you're trying to catch it on the way up, that continuation. I see what you did there. You're like, okay, I'm going to try and catch it when my small triggers roll because this says up and this says up in a clear path, but it's not perfect. I dig it. And then a couple divergences, it just lost the fight with momentum. So Paul, I want to humbly and respectfully apologize for my first assessment. I put the 2 charts together. First trades make perfect sense. You just needed to wait for the pullback to the areas inside of favorable large triggers. Second one makes sense maybe with a little confirmation, but when it starts losing the fight and can't get out of those triggers, it becomes a management opportunity. And Paul, I don't think you're as off base as you may have thought you were on these, and you're definitely not as off base as I thought you were on these. I think great entries. I think entries are going to be the difference. on some of these because your large chart was giving you enough to look for an opportunity. Does that make sense? Good stuff, man. No, there is no I should have seen it. You will see it eventually, right? Because, Paul, one of the things about you and one of the things you've proven is you're a great student. And when we talk about it, you listen. And I see you incorporate lessons all day long, right? And it's okay. There is no I should have. There's always, I'll see it next time. I'll catch it next time. And if you don't, the knowledge pool's a little bit bigger and you'll catch it next time. And eventually you'll get it. Don't put that pressure on you. Wayne, everything says down, you go down. I like it. Comes up, hits the mid band, large triggers a full bar away. There's Wayne capitalizing on the gap theory. A little aggressive on the entry there, without a doubt. Guys, this is what happens when you hit your daily goal in 38 seconds. You start fighting some stuff based on patterns. This is price reaches the mid band, large triggers are a full bar away. Wayne is fighting direction and momentum on 3 charts. But he recognizes a pattern and he capitalizes on it. And Wayne, I would say if you really trusted the pattern, you would have held to these triggers here. This is probably a more conservative entry when the small triggers roll, or at least getting to the other side of them. And then it does everything that you thought it would. And then when the decision's made, right at the key area, right at the triggers, say, hey, we're probably going to go down. You try to ride that wave of momentum. And when momentum goes away, it appears that you're still in the trade because perhaps it may turn into a trend trade. Nicely done, Wayne. Good stuff. All right, Paul. Everything says down, but no momentum. Odds favorable. Clear path. Perfect entry. Those sons of guns didn't want to go down. This is perfect. That was another trade. And guys, this is one of those great things. This is one of those reminders that, yeah, you're probably pretty good at this, Paul. Sniper entry, perfect advantages, and it just didn't work. And I really think the only thing that I could say about this is when they gave you the reversal bar, maybe you could have tightened up just a little bit. It did work out, Wayne. So you held from here all the way up to there and then wrote it down. That did work out. It did work out. From 47.7, you held all the way up to 50. You left $230 worth of risk on this trade, Wayne. I feel comfortable saying I don't think I've ever seen you do that. But that's your trade, brother. It is not usual. All right, Steve, number 1. All right, I'm going to get through this. Moving fast after price clears trouble. The entry, it was 1 second for the chili dog trade. Yeah. And then, Steve, this is another one of those great examples, and I love this. When the momentum trade fails, when the chili dog, when the jump the fudge in trade fails, and your rules are met for a trend trade, very often it turns into a trend trade. And that's exactly what happened. And this is kind of a hybrid, right? It's either the momentum trade or the trend trade. I feel like this is more of a trend trade, pull back to the area, right at the triggers, because you have so many bars up. And the trend trade starts to go down, and you're like, life is grand. And then they start to pull back. And you make a decision. You're like, oh my gosh, do I exit? Is this detrimental? And you go, no, wait. My large chart says my rules are met for a trend trade. And you add on again. And then you take a lot of them off right at trouble. And that trouble happens to be the divergence low. Outstanding. recognizing where the market is likely to go and choosing to get paid at it rather than hoping it just keeps going. And then when it does keep going, you let it clear trouble and you're in and you're out. Easy money. Steve Diego, great trading. And everything, once again, momentum and path. Momentum and path. So if you're new with me in here, I want you to start to believe that momentum and path is a pretty outstanding way to begin to learn how to take advantage of the software. When you get to the point to where you look at your charts and you say out loud, I have momentum and path, I have strong triggers, there's nothing in my way, you're more than likely going to find a way to capitalize outside of the high probability trend trade. Miss Trina, she's like, Mark, you're out of pictures. Let's give you something to do. Strong top, odds favorable, potential to break. 1049, 1049. Miss Trina, you are darn near. You're darn near clear there. You take the perfect entry. You acknowledge and recognize the reversal bar. You go 2 ticks behind it, and it doesn't work out. KISS management. Moved your stop as soon as it printed. First reversal bar got you. And it still went up past the large triggers. So Trina, this is a great example of why that reversal bar is such a powerful stop placement tool. Because that reversal bar says, and you guys know I like to give voices to the market. Let's go all caps. The reversal bar says the sellers see it, they followed through, they want it to go down, right? The failure beyond that says the buyers were not having it. That's all it is. So Trina is able to say, it's doing everything I want it to do. If this is going to be one of those winners, it's probably just going to keep on doing. I'm going to reduce my risk. The buyer said, you know what, Trina? We'd rather it goes up. And you don't know how far it's going to go up. And Trina, what was this? Like a 4-tick loser? Maybe? Maybe a 4-tick loser. And Trina, if you wanted to, you could have gotten back in right here. Or you could have waited for another reversal bar from the areas inside of triggers and say, all right, if they try again, I'll give it a shot, right? I love this management, and that is straight out of the KISS playbook. And it's fun. It's fun to take 4-tick losers instead of 12-tick losers. Because losers happen, right? 5-tick. What is that, the S&P? So that was $62.50 a contract. That was $120, 105. Oh, math. 125, sorry. 125 loss instead of a $300 loss, right? Instead of hoping that the market doesn't go up here to 93, 5 points each. That's heads up trading. That's protecting your investment, guys. That is running your business efficiently. Great job, Miss Trina. All right, guys, I'm going to take just a minute. I'm going to walk away. When I come back, I'm out of charts. Look at that. You had momentum, not odds favorable. Didn't have any areas inside of triggers. The path is most certainly clear. It's not the perfect trade. Whoops. Whoops. Crude oil didn't have momentum. Isn't that amazing? Simple little things keeping you out of losses. I think that's outstanding. If you said, well, it has to go up from the mid-band, you got walloped. You got walloped. All right, guys, I'll be back in about 2 or 3 minutes. When I come back, the classroom is yours. Amen, Jen. Jen just said momentum is everything. Momentum is everything. There was a time where I took some pictures for you guys. And you guys know how my brain works. This is momentum, right? That's momentum. This thing is screaming down the highway. It's going to be hard to stop. There's one thing that can stop something screaming down the highway. It's a termination condition, right? So when you have this, and you have none of these brick walls, life is pretty good, guys. What's the problem with that? The problem as a day trader is nobody wants to wait, right? Nobody wants to wait for the perfect trade because boredom sucks. It sucks to sit still. Pardon my French. Some of you sucks is a bad word. Not where I come from. It's hard to wait. It's difficult to wait. It's challenging to wait and do nothing. But the better you get at sitting on your hands, guys, the easier trading becomes. Example of which one? Needing to wait, where it's okay to wait. That's it. And waiting is a byproduct of trust. When I believe, and when I truly believe, that when I have momentum and path, I don't know, where is one? I know you guys have taken so many. When I truly believe that when I have both momentum and path, I'm going to find a way to capitalize. And when it is void, my trades are less likely to work. When you honestly believe that momentum and path is a recipe for success, and you know that there's going to be times where it's not present, you know that there's going to be times where that edge isn't available, it becomes easier to wait. And the more time you have in the market, the more you believe that that next trade is coming. But what happens is when I sit down to the desk to trade, I'm going to trade. Well, I've already told myself I'm going to get into the market. And I'm not, and who sits down and says, I'm going to wait for rules to be met? Maybe we should start. I'm going to wait for an edge. Maybe that's a good path. I'm going to sit down in front of my screen, but I'm not going to do jack squat until the market tells me it's time to do both jack and squat. Guys, price reaches Fibonacci support and the large triggers are a full bar away. Let's relax for a second. Let's force the small triggers to get through and at least have the potential to break. But it's a bad top. And rule number one for a 50-50 trade is make sure you're coming from a termination that reversed the market. You'll have to make a decision in just a moment whether or not you want to sit tight or whether you want to explore breaking rules. Depends on your rules. I'll be back in a few minutes, guys. Hang tight. I can't wait to come back and see what happens. today. So I have the potential to break. I have the momentum. Heck, I even have the areas inside of favorable large triggers. This is where you guys, whoops, are going to make a decision. You're either going to say, if that reversal bar prints, I choose to take an entry at the area inside of triggers. I know exactly where my stop goes, and I'm willing to forego a strong top. Or you're going to say, you know what? Because it's not a strong top, I choose to not enter at the area inside of triggers because my rules aren't met. I don't have an opinion either way. Some of you have your rules met, some of you do not. My rules are not met. I am willfully breaking my rules, and it would appear that the market has every intention of punishing me. And I have $140 risk on a medium probability trade that breaks my rules. Is it going to work? I don't know. We'll see. If I get a reversal bar, I'll reduce my risk. If I don't get a reversal bar, it means that they're coming to get me. Does everyone see? Not a strong top, only the potential to break, divergence printed. The only rule that I really have met was an area inside of triggers. But I've been just handing out disadvantages. Not from a strong top, divergence prints, and now they're making decisions. See how they stall out? They go up, they go down. They're fighting right at a key Fibonacci area. Oh no. Who's nervous? Is anyone else nervous? They're just making this one, they're making this one, making us sweat. It may be a lesson in stop placement if it's going to work out. It's a weak top, Wayne. It's divergence. I've got, so if I go to the KISS plan, and I'm not saying that this is or is not your trade, but when I go to the KISS plan, this optimizes my chances of success. From a strong top or bottom, well, that's a no, right? Odds favorable in the 13-2, that's a yes. Smalls outside, I believe that was a yes. No divergence, that's a no. So what happens, look at that stop placement. Your rules after up bars on the 13-2, you get out. That's fair. This one worked. Or at least to the first target. Do we go break even now? The challenge is, does it work more often than it doesn't? That's the question that I ask myself. So Jerry, what if two up bars keep you inside of favorable large triggers with areas? And this one won just to piss me off. Pardon my French. Let me show you the exact same pattern from this morning. So you still get out? Right on. So the exact same pattern from this morning was a loser. This one happened to produce a win. So some of you are saying, well, shoot, now I should take it even though it's not a strong top. Now I should take it even though there's divergence. So what you have to do is you have to go back. There's a 50-50 from a strong top. The divergence killed the trade. There's your divergence, off it goes. There's a 50-50 from a weak bottom. Clearly it fails at 10:59. Divergence right from the 1-to-1 blows right through it. You guys see it? So this is how you start to gauge it's not the one trade. There's a 50-50 from a strong bottom, 10:07. What does it look like? 3 divergences and it still went up. That's that crude oil crazy you guys were talking about. So what happens, guys, is it's not the one time that it works. It's not the one time that it fails. You've got to go back and you've got to grab a sample. You've got to go through and you've got to see the same look. And Jerry, you lose about 60% of the time if you stay in through the large chart. Man, that was lucky stop placement, wasn't it? It missed it by a tick. Trading is about an edge. It's about having an advantage. And advantages aren't determined over one trade. Advantages are determined over a sample. If I have odds favorable momentum and a clear path and a pullback to an area inside of favorable large triggers, and I go take that picture 100 times, how many times does it win? How many times does it lose? That's how rules are built. That's how plans are built. This is how people lose a lot of money, because the 1 or 2 times that it works, right? The 1 or 2 times you get away with trading into a termination condition, your brain thinks that's your recipe for success. And I guess that was a harder example because it didn't lose. But remember, plans are built on samples, 20, 25, 40, 50, 100,000 trades, not the one time. And there's nothing worse than me breaking rules in front of you guys and then the market rewarding me for it. Short-term victories, long-term failures. There we go. This is my picture. Short-term victories, long-term failures. I'm the only guy that will complain about winning in front of a live audience. All right, Paul, let's see what you did, my friend. No term. This is not on 13.2, but what about 1-to-1s with divergence? Oh, thanks, Jerry. You have a great weekend, too. Happy Father's Day to you. I like the question, Paul. So let's go through it. Odds favorable momentum from a weak top. Divergence prints. There we go. So divergence on a 1-to-1 I hate. Divergence I hate on a 50-50. What is the question? He says, what about these 1-to-1s with divergence? That's what he's asking. Is this significant? I believe yes. I believe yes to the point to where there was a time. Let me see if I can find it. There was a time where I wrote all these little blogs, and we talked about reasons to exit a trade, and one of them was divergence from a 1-to-1, and I'm trying to find it. So one of the things that you notice is 1-to-1s can create a bounce, no big deal, take a trade. 1-to-1s with divergence are very often pushes the other way. And it's such a consistent pattern that there's just no way I would have taken this trade. And I did anyway, and it goes down, and some of you took it, you made money. It's just not my trade. But if you scroll back, and again, patterns are made off of samples, guys. Lots of stuff. Divergence from a 1-to-1, there's your deeper push. Divergence from a 1-to-1, there's a pretty good push up. Divergence from a 1-to-1, there's your deeper push. Divergence from a 1-to-1, there's your deeper push. So everything is patterns, right? Everything is patterns. So if I'm looking for a medium probability trend trade, and I get divergence from a 1-to-1, I should be less inclined to take that trade, because that's a pattern that more often than not ruins the good time. Oh, the JOB, man. Victor, thanks for being here, man. What a great week we've had. I hope you've learned a lot. I hope you're enjoying it. I hope to see that green check next to your name. We get you for life. Have a great weekend. Happy Father's Day if it fits the bill. I'll see you next week, man. Take care. And then there's 3 divergences in the same price range. We know that pattern. Trading's about finding what's good for you, right? What makes you happy? Happy Father's Day. And then there's weak triggers right at a termination condition, guys. Coincides with 3 divergences in the same price range. Of course I will, Steve. Let's do that. Let's go to the website to look at it, though. Paul, did that answer your question on the divergence from 1 to 1s? I think it's a very powerful indication. If my large chart's perfect, man, I'll very often wait for a reversal bar to get me in. You're welcome. I appreciate y'all's questions. All right, could you explain the daily loss limit and drawdown work with the Nexgen funded account? So let me find evaluation rules. I believe it's on this one. All right, so here we go, Steve. Can we do $50,000 account? Because they're all different, but we'll talk about it. So if I'm trading a $50,000 account, my target is $27.50, right? So that means that in this account, that account has to go to $52,750. That's what it takes to pass. When we talk about daily loss limits, so this means if I wake up Monday, by the end of the day, I can't lose $1,300 in the account. That's it. So what it is it's saying we want consistency. We want profitability. We don't want gamblers. We don't want fighters. So on a $50,000 account, your loss limit for a day, you can't lose more than $1,300 in a day. If you lose more than $1,300 a day, if your account goes down to $48,700, that is a failure of the exam. Does that make sense, Steve? So that's your daily loss limit. Let's say that the day gets going, right? And the first day I lose $500 and I stop. I'm like, well, I don't want to hit my daily loss limit. Things aren't going right. I need to get my head straight. And then the next day I do it again. I'm still fighting triggers. I'm still trading into termination conditions. And now I'm down $1,000 in the account. And that's okay. I'm learning. I'm working through some stuff. And then the next day I lose $300, right? And this is over 3 days. And now I'm down $1,300. But I didn't lose it in a day. I'm good. I'm still in the game. The next day comes in and I'm like, I'm just aggravated. I'm revenge trading. And I lose $800, right? So now I'm down $2,100 in the account, but I still haven't hit my max drawdown, and I'm still on day 1, 2, 3, 4. As I go into my 5th day, I take my first trade. I have $300 of risk, and it loses. Once it hits 250, I've reached my 2250 max drawdown, and the account has been failed. Does that make sense? So that's what it is. There's a don't lose this much in a day, and that's going to help you manage. When things aren't going right, guys, it's okay to say to yourself, wow, either the market's off or I'm off, but I can't seem to find a winner. Let me stop before I start blowing out accounts. The other one is, man, I'm not finding my groove. Maybe I need to go to Sim for a day and find it back. So that's how those work, Steve. And remember, commissions are a part of it too. So if you're cutting it close and over trading, the 2250, where are we talking about? Right here? Nope, that's in the account forever, Paul. So if I'm in an account and it goes down 2250, that's it. I'm done. And guys, remember, if you fund an account and you're in a position where you can get paid and you hit your max drawdown, you lose the account. So take your withdrawals. Proprietary firm accounts are not bank accounts. Don't try to build them up so you can have some big ego-filling um, withdraw. Guys, because if you're up 10 grand in this account and you lose the 2250 max drawdown, you lose everything. So learn how to get paid. Learn how to get paid consistently. In my example, you would need to reset the account. Exactly. So I built this, and this is for you guys that like to hit home runs and hate base hits. And I'll drop this in the room if you want. So what I did is I took the different account sizes, and let me drop this in the room for you. Because guys, I want you all to win. I want every one of you to be pulling money out of this. So depending on the account size, each one has a goal. So what I did is I did the math. All right, if I'm going to pass this account in the 5 days that you have to trade to do it, what do I have to make daily? On a $25,000 account, I only have to make $250 a day. 50 is 550, 850,000, and it goes down depending on the size. So it takes 5 days to pass, and then it takes 5 days to create the buffer so that you can start to get paid out. For the first 60 days, guys, there's a max payout that you can take. And there's 5 payouts within that 60-day period. So the daily goal, if you do it 8 times, because there's eight trading days in a payout, you'll have $2,000 above your buffer. Well, you can take $1,250 out, which means that you've got $750 left over. Every 8-day cycle, there's an extra $750 that stays in the account. That's a wonderful thing. Because what happens is after the first 60 days, if you're just making $250 a day, you've got an extra $3,750 in the account. And on your next payout, you qualify to take 90% of it. So we keep you consistent. Let's do it for 60 days, 5 payouts. This is the max you can take out. But we're still going to reward you because after that 60 days, depending on the size of the account, if that's your consistency rate, this is where you're at, which means it's an additional to whatever you make that 8 days. And I built this because I think all too often we trade to the point of failure. We hit goals and we want more. We reach goals, we want more. We obtain our profit target, but dang it, at this point I've got a Superman cape and I just want to keep going. And guys, I can't tell you how many prop firm accounts I have blown out when I was up $1,000, $2,000, $3,000 in the day. I started pretending I was Superman. I started getting risky. I started breaking my rules. And then when I gave half of it back, I swore it was only one trade to get it back. And I blew out. And I'm not proud of that, but that's what traders have to go through to get their mental mind straight. Can you imagine only having to make $250 a day? And if you do that consistently, you can start taking $1,250 every 8 days from the Nexgen Pro Trader Funding Company. And over the first 60 days, it's an extra $6 grand. So over the first 60 days, at $250 a day on a $25,000 account, guys, you are literally, you've paid for your software, you've paid for your funding accounts, you've paid for your activation fees, you've paid for everything. But you don't get paid if you're not consistent. $550 on a $50,000 gives you a little more wiggle room. And then, guys, once you start doing it, keep the goals the same. Copy it. And you can see how the money grows exponentially with a copier. You can copy 2 accounts. You can copy 5 accounts. You can copy 10 accounts, right? I think 5 is the limit initially. I believe it's 5 a turn. I believe, Steve. You would want to double check me on that. But I believe it's 5 a turn is what they're putting in on it. That's what AMP charges. And that gets factored in after the end of the day. Paul, I think most traders would say I can make $250 a day easy, right? And the people that say they can make it easily aren't, because they're not stopping or because they're going outside of the rules. So proprietary firms, Nexgen Funding Company, is an opportunity for you guys to prove that you can be consistent. It's a